Hello, Namaskar. I am CA Shailesh Bore, your moderator, session moderator for this live webinar on profit and gains of business or profession under Income Tax Act 2025, organized by Direct Tax Committee of ICAI. I warmly welcome all of you for this webinar. This webinar is being organized by Direct Tax Committee of the ICAI. Today, we have among us as a speaker, CA Kotha Srinivasan. For opening remarks, CA Pankaj Shah, and welcome address by CA Chandrakant Chitle sir. Due to some their occupations, CA Pankaj Shah sir would be joining us. Meanwhile, I would introduce himself. CA Pankaj Shah, being a vice chairman of the DTC committee, is a distinguished chartered accountant with a proven track record in excellence in direct tax litigation, business restructuring, holds a multiple qualification including FCA, CS, BBA, and LLB. A Central Council member of the ICAI, serving in various standing and non-standing committee of the institute. CA Pankaj Shah has delivered over 1,000 plus technical seminars showcasing excellent communication and presentation skill. Sir has authored many articles in ICAI journal, AIFTD journal, and also editor of ITJ magazine. A direct tax litigation and restructuring specialist, Pankaj Shah sir has assisted numerous clients in resolving complex tax issues, an expert in legal and financial and business matter. With this brief introduction, now I will introduce Chairman DTC Direct Tax Committee of the ICAI, CA Chandrasekhar Chitre sir. Chitre sir, by qualification, he is a commerce graduate, LLB and FCA, senior partner of CV Chitle and Company. Sir has qualified in the year 1984 and started his career as a director of tax practice and also. Okay. Now is it audible? Okay, we will slow it down. Okay. Sir, now I am introducing CA Chandrasekhar Chitle, who is the CCM and also chairman of Direct Tax Committee, a qualified chartered accountant in the year 1984. He started his firm in the name of CV Chitle and Company. Now he is the senior partner of his firm. Sir is involved in direct tax practice and legal drafting. Recently enters in the field of mediation. DTC, under his chairmanship, Sir has drafted a DTC revised guidance note on tax audit under Section 44 AB after a gap of 8 years. A peer review guidelines also drafted by his committee. Several publications were brought out as a committee chair. Sir is a member of Central Council, member of the Institute since 2019-22 to till date. A chairman of the Direct Tax Committee, conveyor, publication director, and VC of Taxation Audit Quality Review Board. A member of QRB of MCA, former chair of the Peer Review Board, Corporate Law and Governance Committee, a treasurer of MCCIA, was nominated on Cost Accounting Standard Board of ICMA, chair of Pune branch of ICAI, a former lecturer and at various colleges and management institute, authored various articles in Taxman, CA and CMA journal, also authored user guide on tax audit. With these brief introductions, I now take this opportunity to introduce a session speaker, today's webinar speaker, CA Kotha Srinivasan sir. Sir is a BCom graduate from Bangalore University, a fellow member of the ICAI, a member of Institute of Cost and Works Accountants of India, founder partner of SSB and Associate Chartered Accountant Bangalore. Sir has served Institute over 2 decades.
Said Kathy is now disconnected.
2.5 years as a student committee member of Sikasa Bangalore branch, 9 years as a managing committee member of Bangalore branch, 9 years as a RCM of SIRC, and 3 years as a CCM of ICAI. A student committee members as a member and secretary of Student Association. During his tenure at Bangalore branch of SIRC, he started distribution of backpack bags to CA students. So far, 25,000 students have been benefited by the initiative started under his tenure. During his tenure, the branch was adjudged the best branch of the SIRC. In the year 2010 to 2019, he served as a RCM at SIRC. Sir, as a member of the SIRC, I've brought many initiatives, including conducting ARRC, Annual Regional Residential Process on International Taxation, successful conducting 5 ARRCs on international taxation. He was instrumental in collecting around 1.5 crores towards CABF in the year 2017 and 18. Conducted 1000 plus CPF programs of SIRC during the year 2017. As a CCM, he also served Institute for the year 2022 to 25. Got approval for construction of COE of Bangalore, ensured completion of Bangalore gifted property at Rajaji Nagar, and taken various initiatives under his leadership as an CCM. Also presented papers on various study circles, meetings, workshops, seminars, conferences on topics covering direct tax and international taxation. A visiting faculty at ICI Bangalore, authored a book named CA Referencer for Chartered Accountant. Sir is a life member of Karnataka State Chartered Accountant Association, life member of BCCA Society, founder group of Dynamics, a study group of international taxation at Bangalore Chamber. There are a number of groups. Sir is also fondly known as Think Differently and Act Perfectly. With this distinguished faculty we have today on this webinar, Profit and Gains of Business or Profession under Income Tax Act 2025. I now hand over to webinar faculty, CA Kothas Srinivas. Over to you, sir.
Thank you. Thank you. Am I audible?
Sir, yes, sir, yes, sir.
Okay, okay. So, namaste to all of you, all the participants across India. And let me first thank the chairman of DTC, Chandrasekhar Chittale, who requested me and approached me to make a presentation on profits and gains of business or profession, the vice chairman Pankaj Shah, and today's moderator Shailesh Bore, who introduced me for this particular thing. I can share my presentation, right?
Yes, sir.
Yeah. It's visible, na? Okay. So, good evening, participants. Once again, we'll have a discussion. Welcome to this particular discussion. Just 1 second. Okay. We will now move on to this particular topic, profits and gains of business or profession. As on today, all of us are aware that the new Income Tax Act was introduced 2025 from 1st of April 2026. And on the same day, the Income Tax Act 1961 got repealed. By this time, you are aware that the new act has been implemented and is ongoing. We would have also attended various seminars in your branches and have some knowledge about the new Income Tax Act 2025. What we are going to discuss today the introduction part, the concepts that we are going to discuss is the introduction, the business allowances, business disallowances, some of the special provisions, books and tax audit, and miscellaneous provisions. When I say income from business or profession, I consider some 4 aspects or 4 segments which are very important when you have to know about the business or profession. No one can say when I say business or profession, it's none of my business, because it is everybody's business to know about the provisions of income from business or profession. Because if you see overall tax collections or taxpayers, most of the things will come from income from business or profession. Coming to the introduction, before going to the general introduction of business or profession, we know that there were a lot of amendments in the simplified law. The number of sections which came to around 819 have been brought down to 536 when it was introduced in the year 2025. Income Tax Act 2025 was introduced on 21st of August 2025, and there were amendments made to this particular act during the Finance Act 2026. In the Finance Act 2026, many amendments happened to the Income Tax Act 2025. And before it was introduced on 1st of April, some amendments like two sections were omitted. So 443 and 447 sections were omitted. And in the year 2025, when this particular act was introduced, we didn't have any alphanumeric sections. Now, in the Finance Act 2026, one alphanumeric section has been introduced, that is 354A. So in substance, today, if you ask me how many sections are there in Income Tax Act 2025, it is not 536 sections. The active sections are 535 because out of 536, two sections were deleted and one section was added. That is 443 and 447 were deleted and 354A was added. So in this thing, if you want to have in practice, like if you want to say how many active sections are there in Income Tax Act 2025, it is 535. And we have one alphanumeric section. Coming to the structure of profit and gains of business or profession, like it is covered under Chapter 4D. If you see, even in Income Tax Act 1961, it was under Chapter 4D only because heads of income is defined under, discussed under Chapter 4. 4A is heads of income, 4B is salary, 4C is house property, and 4D is business or profession. So there is no change with respect to the chapter. 4D is there in 1961 Act also, in 2025 Act also it is 4D. But the sections covered are around 41 sections. Earlier it was from 28 to 44. Now it is 26 to 66. As we know, many of the this thing, what you call this, alphanumeric sections have been removed and it has been numbered sequentially. So there are sections which has been sequentially numbered, and wherever there was certain provisos or exceptions, the explanations, that has been made as a subsection in the Act itself. So in income from business or profession, we are covering around 41 sections, that is from 26 to 66. The rules covered are around 27, 22 to 48, and schedules covered are around 6, 9 to 15. But today we are not discussing about the rules that has been covered or schedules that has been covered. We only concentrate on the sections that has been covered under profits and gains of business or profession. These are some of the important definitions of Section 2, which I may not be discussing in detail. Like 249 is income and 217 is block of assets. 219 is books of accounts, and next 245 and 275, Section 245 and 275 talks about a firm and partnership. So whenever in the Income Tax Act 2025, you come across the word firm or partnership, it means both the partnership partnership firm registered under the Indian Partnership Act 1932 and LLP registered under the LLP Act 2008. So wherever the word firm or partnership comes, whether it includes both partnership firm and LLP. The definition in 245 and 275 is one and the same, except the first word, that is partnership or firm. So both the definition, if you see, these are all defined under Section 2. Partnership means, or firm means, it will start, means a partnership firm registered under the Indian Partnership Act 1932 and the LLP registered under the LLP Act 2008. Now, in the introduction section, we are discussing this two sections, that is Section 26, income under head profits and gains of business or profession, and Section 27, manner of computing profits and gains of business or profession. See, if you see the right hand side, I have given even the corresponding sections of Income Tax Act 1961. The 26 was 28 last time and 27 is 29 last time. So Section 65 and Section 66. Like Income Tax Act 1961, even in Income Tax Act 2025, the first section is a charging section and the last section, or last but one section, is the definition section. But in 2025 Act, instead of definition, they have named it as interpretation sections. So if you see the Income Tax Act 2025, you may see around 13 to 14 sections as named as interpretation, which is interpretation for the respective chapters. So instead of definition, you will get it as interpretation. And in this presentation, I have removed certain sections for the discussion because of the time constraint. Usually it may take 3.5 to 4 hours to discuss all these things. But since we have around 2 hours time, I have removed so many sections from the discussion point of view, which I will share as a PPT PDF format, which it will be shared to the DTC. Maybe they can host it on the website. You can go through all those other sections. The first section is the charging section. Income and direct profits and gains of business or profession. They are dealt under section 26, and section 27 is manner of computing profits and gains of business or profession. Section 65 is an interpretation for purpose of section 64. So interpretation means they have defined certain terms with respect to only section 64. There is some section 64 which talks about reorganization of cooperative societies. For that, they have defined certain terms. And section 66 is an interpretation section for entire chapter 4D. Around 40 terms have been defined under section 66. I will not be discussing that except one section. We will go to charging section 26. So earlier it was section 28, the charging section 26. It has got 4 subsections. Subsection 1, subsection 2, 3, and 4. Subsection 1 says any income referred under subsection 2 is taxed under this head, that is profits and gains of business or profession. And subsection 2 gives the list of income, the income that has to be taxed under the head PGBP. And subsection 3 says any income under speculation business, income from speculation business should be charged to tax as income from business or profession. And subsection 4 says if the associate has got income from any property, then rent income from letting out of any property should be taxed under the head income from house property and should not be charged to tax under business or profession. So this is the charging section 26. Now we will go to section 26(2). What all the income that has been referred or discussed in the section 26 subsection 2. So section 26 subsection 2 is an inclusive definition. It's not an exclusive definition. We know the difference between inclusive and exclusive definition. In case of inclusive definition, it starts with the word includes, and whatever the list that has been mentioned in the inclusive definition, it's an illustrative list, and any items or anything similar to that particular list can also be added to the definition. So 26 subsection 2 is a illustrative list, and it has got certain items which has to be considered as income from business or profession. 26(2)(a), it talks about profits and gains of any business or profession at any time during the tax year. So if you are earning any income from either from business or profession, that needs to be charged to tax under this particular head. B talks about compensation received. So compensation received in connection with any termination or modification of terms where a person is managing a particular company in India or an agency business in India or any contract relating to business in India. If a person is managing these businesses and if he is receiving certain compensation during that particular year of management, that may be considered as income from salary. But when this particular management is being terminated or some modifications happening and he receives certain compensation in connection with this termination or modification, that amount will be considered as income from business or profession. Similar to that, if a person is managing any property or business in India and after some time he is vesting his right, he is giving away this particular right to government. So in those cases also, if he receives compensation, that will be charged to tax as income from business or profession. Otherwise, generally it will be treated as income from salary. And we have this trade and professional associations where they have a specific objective of performing services to the members. Any income that is being earned by this trade or professional bodies will be considered as income from business or profession. Then comes this export incentives. So any person does any export, he will have certain benefits. One is he can get import entitlement, which he can sell, or he may get some cash assistance, or he may get some duty drawback, or any other export incentive. Whatever that he receives with respect to the export trade will be considered as income from business or profession. This was there in the 1961 Act also, but only the last one, this any other export incentive was added in this particular sentence was added in the 2025 Act. Even if it was not added, as I said earlier, it's an inclusive definition. Anything similar to that was already been taxed under income from business or profession, but now they have added this particular phrase, any other export incentive. Next comes value of any benefit or perquisite arising from business. See, these things we have seen whenever when you have been doing the audit. It was introduced a couple of years back. Like whenever a person receives benefit or perquisite from a particular company, the TDS will be done under section 194R. So those things whenever the person receiving this benefit of perquisite will be charged to tax as income from business. Next is the bricks received by a partner of a firm or LLP. So what is this bricks received by a partner or firm? A partner of a firm is the bonus, remuneration, interest, commission, and salary. So whenever a person being a partner of a firm receives these type of payments, and to the extent that has been allowed as an exemption or reduction under section 35, that will be charged to tax in the hands of the partner as income from business or profession. Next, any sum received for not carrying on a business activity or not sharing business rates or no, this may be considered as non-compete fee. So say suppose for an example, there is a partnership firm where a person is retiring from a particular firm or LLP, and there is an agreement that he should not continue this particular business, that is non-compete fee, or there is an agreement or this thing where he should not share any information about the existing company as such. So if he receives anything, any amount towards this, it will be considered as income from business or profession. Or any amount received under a key man insurance policy is also considered as income from business. And now 26(2)(j) talks about the fair market value of inventory that has been converted into capital asset. So all these years we have been studying that capital asset converted into stock in trade. This is a reverse, where stock in trade is converted into capital asset. On the date of conversion, the fair market value of that particular asset will be considered as income from business or profession. And lastly, we have situations where we have specified businesses. Earlier it was section 35D, now it is section 35AD, now it is section 46. Under the section 46 of 35AD, any capital expenditure incurred towards the specified business was allowed as a deduction. Now also it will be allowed as a deduction. So assume that earlier they have claimed it as a reduction for the assets, the capital expenditure incurs towards acquisition of assets, and subsequently when they transfer that asset, discard or dispose of that particular asset, any amount received will be charged to tax as income from business and profession. So these are the subsections which talks about the income 26 subsection 2. As I said, similar to this, any other income from business or profession also is charged to tax under the head income from business or profession. Moving on to the next section, section 27. This talks about manner of computation of income from business or profession. So how to compute the income from business or profession? It says the income referred to in section 26, that is the charging section, shall be computed as per the provisos stated from section 28 to 60, except section 58. So 28 to 60. Now we have understood section 26 as a charging section. Then this is section 27. From 28 to 60 it says. So we have sections 26 to 66. So this is 28 to 60, except section 58. The except section 58 is section 58 deals with presumptive taxation. Earlier in 1961 Act, we had 3 sections covering the presumptive taxation with respect to residents, that is 44AD, 44AE, and 44AF. Now, 44ADA. Now all the 3 is combined under one section, that is section 58. Now we are discussing about income from profits and gains of business or profession. Before that, if I have to ask you a question or if I have to answer the question, we have 5 heads of income, and the sections covered for all these 5 heads of income under the 1961 Act was from section, it started from section 15, it went up to section 59. If you remember, the first section of income from salary starts at section 15, and the last section of income from other sources was section 59. This was in 1961 Act. When it comes to 2025 Act, here also the first section is section 15 for the heads of income, but the last section, instead of 59, you have to read that reverse. It goes up to 95. So in Income Tax Act 2025, all the 5 heads of income, it covers from section 15 to section 95. Now, before going to business allowance, as I said earlier, there are 4 verticals. Whenever you have to understand the income from business or profession, what I feel the 4 verticals. One is business allowances. The second vertical is business disallowance. The third vertical for the local practice or national practice, if I have to say, that is presumptive taxation. And the fourth vertical is maintenance of books of accounts and audit. So today we will try to cover these 4 aspects of the 4 verticals, that is business allowance, business disallowance, then presumptive taxation, and finally books of accounts and audit. The first one is the business allowance. Before getting into the statutory business allowances, I've just made one checklist for business allowance. What are the checklists one has to see before claiming a particular deduction as a business allowance? First one is the purpose. So what is the purpose of a particular expenditure? What is the purpose? We have to see the intent of this particular expenditure. So it should be wholly and exclusively incurred for the purpose of business or profession. Then we have to check ordinary and necessity. When I say ordinary and necessity, you would have come across various clients where certain type of clients will have certain type of expenses. It's not that the expenses of one type of client will be same with the other type of client. So there may be specific expenditure type of expenditures with relate to one particular industry or client as such. So when I say ordinary and necessity, if you have to see whether this particular allowance has to be allowed as a business allowance, you should see whether it is incurred in the ordinary course of this particular industry. Then next we should see what is the necessary for incurring this particular expenses. The necessity for allowing this particular expenditure. Then comes the expenses relatable to income earned. That is, in the accounting parlance, we call it as matching concept. So whatever the income you offer, to that related expenditure has to be allowed. Like earlier, we had section 14A in the 1961 Act. Now it is section 14, which says that if you have earned income which is exempted, and that particular exempted income, any expenses related to this particular exempted income will not be claimed as a deduction. So like that, the matching concept has to be there. So whatever the expenses relatable to income earned, so whatever the income you offer it for tax, related expenses only will be allowed as a deduction. Then it should not be a capital expenditure. All of us are aware that whenever we claim the business expenditure, it's a revenue expenditure, it's not a capital expenditure. However, there are certain exceptions given in the Act itself. Some of the sections will allow capital expenditures also. So in those cases, capital expenditure can be allowed. Otherwise, generally, it will be a revenue expenditure. Then comes the genuineness of expenses. We have to see the genuineness of a particular expenditure. Whenever you get an expenditure voucher or whenever you are we are allowing a particular expenditure, we have to ascertain the genuineness of that particular thing, whether it is a false purchase or false expenses. So all those things, the genuinity of a particular expenditure has to be ascertained before claiming it as a business allowance. Then comes this incurred in relevant period. So we are talking about relevant period. Usually we compute the taxation, the income for a particular tax year. So the expenditure also should be for the relevant period. So it cannot be that I will take income of 1 year and I will claim expenditure of 2 or 3 years. It cannot happen like that. So whatever the income for a particular period we are offering or we are arriving at, for the same period, income expenditure also should be there. Now there are certain situations where you will claim it as amortization of expenses. Some of the amortization of expenses are there where it will allow more than 1 year. So like preliminary expenses we can claim for 5 years. So it would have been incurred in the previous years, but it will be allowed in a relevant period. So it's all very small, very few sections which will allow amortization of expenses. Apart from that, most of the expenses, it should be incurred in the relevant period for which income is offered. Then the method of accounting. So we have different types of method of accounting, that is mercantile system of accounting or cash system of accounting. We have to see which type of accounting that we are following, whether it is accrual system or cash system. Accordingly, the expenditure has to be allowed. Then reasonableness. Earlier we had section 48(2), now which is section 36. Where if the amount is being paid to specified person or a relative, the assessing officer feels if the expense is unreasonable or expensive, then the unreasonable amount, it can be disallowed. So this can happen not only with the payment made to the specified person or the relative persons. The assessing officer has got right to question any expenditure. Whatever expenditure you make to any person, if he feels that it is unreasonable and it is very expensive, then there are chances that this objection may be raised on that and a notice may be served and it may be disallowed also. So before allowing any particular expenditure, we should see the reasonableness. Then comes the mode of payment. So mode of payment means like we were discussing about in 1961 Act, they were talking about cash. But when it comes to section Income Tax Act 2025, section 66, which is the interpretation section, 66 subsection 32 talks about specified banking or online mode. So they define a word called specified banking or online mode. So we have to see the mode of payment. What is specified banking? Specified banking means if in case a person is issuing a check, it should be an account pay check, or if he is issuing a demand draft, it should be an account pay demand draft, or any other methods allowed by the RBI, which the banking institutions will follow. That is, it may be IMPS, it may be ECS, it may be RTGS or NEFT or any other type of transactions which the RBI allows and bank generally does. That's all considered as specified banking activities. Plus online mode, or online mode means it may be through UPI or BHIM app where you do the online transaction, digital transfers you make. So the mode of payment also depends whether it is specified banking or online mode or otherwise. So if it is otherwise, there are certain sections which will disallow that particular expenses exceeding a certain amount of transactions. And finally, we come to any other statutory compliances. Whenever you have to, what you call, allow a particular expenditure, we should see other statutory compliances. There may be various statutory compliances, but important statutory compliance which I would like to mention here is the TDS compliances. So we have to see whether the TDS is available or deductible, and if they have deducted at what rate. All those things have to be seen before claiming any deduction as a business deduction. So this is a checklist which I have prepared for business allowance. Now we will move on to the statutory sections which allow the business allowances. So these are some of the sections. There are some more sections, 28 to 34. Then we have 44 to 49 and 51 and 52 sections are there. So these are the specific sections which allows a business deduction. So if you see here, Income Tax Act 1961, there are certain sections which have been combined. So like here for section 28, they have combined section 30, 31 and 38. Even section 29, 36 and 48 has been combined. Even for depreciation, 32 and 38 has been combined. So like when once they wanted to bring certain provisions at one particular place, they have done all the realignment in this particular new act. So we can see some of the sections wherever it was scattered in under different sections, they have brought under one section. So section 28 talks about rent, rates, taxes, repairs and insurance. Then section 29 deals with deductions related to employee welfare. If you go to the employee welfare, this section 29, all the related employee welfare expenses will be in one particular section in each and every clause. Section 30 talks about deduction on certain premium. Section 31, deduction for bad debts and provision for bad and doubtful debts. Then other deductions under section 32. Section 33 talks about deduction for depreciation, and section 34, general conditions for allowable deductions. Earlier it was section 37. So when I talk about section 28, rent, rates, taxes, repairs and insurance. So when a person, assessee, is owning a particular property or taking a particular property on rent and he is doing his business or profession, whatever he pays as rent will be claimed as a deduction under this particular section. Or assume that he is owning that particular property, he is not paying rent, but he is paying certain taxes. It may be municipal taxes or land revenue that will be allowed under this section. Either owning a property or leasing out a property, renting out a property, and he has got an agreement that he will incur certain expenditures, repairs and maintenance expenditure towards the building or plant and machinery or furniture and fixtures, that also will be allowed as a reduction under this section. Then to maintain the building, the furniture and plant and machinery, if he buys some insurance, that also will be allowed as a reduction under section 28. Section 28 subsection 2 says, if the particular assessee is not using the entire premises, say the entire building, plant and machinery and furniture entirely for the purpose of business or profession, only that proportion which is using for business or profession will be allowed as a reduction. The rest of the things will not be allowed as a deduction under section 28. Next comes deductions related to employee welfare. So there are various deductions that an employer will pay towards the employee welfare. So to name a few, it may be income, the contribution towards PF, then it may be contribution towards ESI, then gratuity, superannuation, Then there may be certain things like what you call this leave encashment. So various deductions, various contributions will be made by employer towards employee welfare. When I talk about employee welfare, there are two types of contribution, especially if I take the example of ESA and PF. There are two types of contribution. One is employee contribution, one is employer contribution. All of us must be aware of this. So there will be two types of contribution. One is employer contribution, one is employee contribution. Whenever the employee contribution is deducted from his salary, that is considered as income in the hands of employer. So under section 224 earlier and section 249 in the new act, it is considered as an income. And whenever they make that particular remittance to the respective acts or respective funds, it will be allowed as a deduction. So under section 36(1)(5)(a), earlier it was allowed as a deduction. Now under section 29(e), it will be allowed as a 29(e) or F, I don't remember. It will be allowed as a deduction. Earlier, what was there in section 1961 Act, the condition was whenever it is an employee deduction, that is contribution towards employee deduction done towards ESA and PF, that was supposed to be remitted before the due date mentioned in the respective acts. The due date mentioned in that respective act is 15th of the subsequent month. Say suppose if I take an example, in the month of March 2026, you have deducted from the employee towards ESA and PF, that needs to be remitted before April 15th, that is 15th of the next month, subsequent month. If you remit that on 16th of April, then it will be disallowed. So this is the law in 1961 Act. So from April 2025, when we are doing the audit in the coming months, April 2025 to March 2026. So whatever that has been deducted from the employee for a particular month, that needs to be remitted in the subsequent month before 15th. So say for example, March 25 deduction, it has to be remitted by April 15 and so on and so forth. So it should be remitted before 15th of the subsequent month. Even if there is a delay of 1 day or 2 days, it will be disallowed. This is the existing provision under the Act, under the Income Tax Act 1961. Now coming to Income Tax Act 2025, in the Finance Act 2026, there was an amendment where it said it has amended section 29, which says from April 2026 onwards. So for the month of April 2026 onwards, the deduction, the collections that has been received from the employee towards ESA and PF can be remitted by the employer before the due date for filing the return of income under section 263 subsection 1. Earlier 139(1) is 263 subsection 1. So for the current financial year or the tax year, if I have to say, April 26 to March 27, whatever you collect from the employee, deduct from the employee towards ESA and PF, that can be remitted up to 31st of October 2027. That is due date for filing the tax audit return. So that is the provision that has been made. So this will come into effect for the current tax year. It will not apply for the previous year. So while we are doing the audit for the current year, we have to maintain the same status quo which was there in the earlier years, that if there is a delay of even 1 day, it has to be disallowed. Going forward from April 26 onwards, even if there is a delay, say suppose now we are on today June, we are on June 25th. Say suppose May 26 deduction, today if he has remitted also, it will be allowed as a deduction. It is not that it has to be remitted before 15th of June. It can be remitted today also and it will be allowed. And even if it is remitted up to 31st of October 2027, it will be allowed as a deduction, provided it is under the tax audit. Next, deduction on certain premiums. Section 30 deals with deduction of certain premiums. Here, certain premiums means basically it talks about the insurance premium. So when once the employer is using certain assets or even stocks and consumables, if he takes an insurance premium, insurance policy to maintain this particular stocks or to have this particular have this insured, so that will be allowed as a deduction. Or if the employer is taking a group medical insurance policy on its employees. So we would have come across the employer taking group medical insurance policy for all his employees, that will be allowed as a deduction. And in case of milk federation societies, where the assessee takes insurance on the livestock or cattle, that will also be allowed as a deduction under section 30. So insurance against stocks or stores, insurance on health of employees, and livestock or cattle insurance in case of Federal Milk Cooperative Society. Then comes section 31, deduction for bad debts and provision for bad and doubtful debts. So here in this particular section, if you see, for banking institutions or banking companies, there are certain percentages. So out of the total income they earn, there may be they can allocate certain percentage of that particular profit as provision for bad and doubtful debts. There are percentages that has been defined under this particular section, section 31, for all these banking companies, including cooperative banks. But in case of other entities, which is not a banking industry, other entities, they can, if they have a debtors, and if we feel that it is irrecoverable, so the debtors is outstanding, and we feel, the assessee feels that it is not recoverable from the particular debtor, that can be taken as bad debt. So that is what section 31 says. In case of other entities, actual bad debts written off as irrecoverable is allowed as deduction under section 31. Then comes section 32, other deductions. We have various clauses under section 32, around 8 to 10 clauses are there. Let me discuss with you a few clauses. Other deductions, which has not been covered under the previous sections. Like one of the thing is bonus or commission paid to the employees will be allowed as a deduction under this particular section. And any interest paid on borrowings. So usually for a particular business or profession, they may require certain amount, borrowings, loans. So any interest paid on that borrowings will be allowed as a deduction under section 32. But there is one thing, if the assessee has borrowed certain amount for acquiring a fixed asset, for suppose acquiring a fixed asset, and the interest paid on that particular borrowing till the date that a fixed asset is put to use will be capitalized. Subsequently, it will be claimed as a revenue expenditure. So that interest paid on borrowings, which is used for acquiring a capital asset, till the date that particular capital asset is installed or put to use, any interest you pay will be capitalized, and subsequent interest after that it has been put to use will be claimed as a revenue expenditure. Then comes this, what you call this security transaction tax and commodity transaction tax, that will be allowed as reduction under section 32, provided the income is offered as income from business. So if you are offering the income as capital gains, the STT paid will not be allowed as a reduction, or CTT paid will not be allowed as a deduction. Then in case of industries, sugar industries, where they pay to the farmers for buying the sugar cane, there will be a fixed price fixed by the respective state governments for purchasing the sugar cane. So there may be a situation where the factories will be paying that particular fixed price, or in some situation they may pay less than the fixed price also. That will also be allowed as a deduction. Then one more deduction under section 32 is in case of promoting family planning among the employees. So if they are incurring any expenditure towards promotion of family planning among the employees, the revenue expenditure will be allowed as a deduction. When it comes to capital expenditure, this is one of the section where capital expenditure will be allowed, where employer is incurring certain capital expenditure for promoting family planning among its employees. The total expenditure will be allowed over a period of 5 years. So if suppose expenditure is incurred in particular year, 1/5 will be claimed in that particular year. The remaining 4/5 will be allowed in the next 4 years as 1/5 and 1/5 like that. So this is one of the sections where capital expenditure is also allowed as a deduction. See, this is section 32. Then comes section 33, deduction for depreciation. In fact, earlier section was section 32, now it is section 33. All of us are aware why depreciation is being claimed. So depreciation is claimed usually for the wear and tear of the asset, where it will be used for the purpose of a business to arrive at the correct profit. Even the usage of that particular asset has to be claimed. So the depreciation has been provided. That is one reason. The second reason may be to replace this particular asset after the end of the useful life of that particular asset. So that is one of the intention why we provide depreciation under section 33. So section 33 has got 12 subsections. It has got 12 subsections. So let us see what all those 12 subsections, what it discusses. Section 33 subsection 1 talks about the allowability of deduction of depreciation. So section 33(1) gives the what is the powers to claim the depreciation, and it says it is being allowed on both tangible assets and intangible assets. So depreciation can be allowed as a deduction under section 33 subsection 1, both on tangible and intangible assets. In case of intangible asset, it says whatever the intangible assets acquired after 1st of April 1998 will be allowed as a deduction. Before that, it will not be eligible to claim the depreciation. Plus, any self-generated goodwill also will not be eligible to claim the depreciation section 33 subsection 1. 33 subsection 2 talks about power generating units. So we have some units which generates power and distributes power. For those industries, section 33 subsection 2 says depreciation can be claimed for those units under straight line method. So usually we calculate depreciation on straight line method under the Companies Act, but even under the Income Tax Act, there is a provision with respect to this power generating units where you can claim depreciation on straight line method. Section 33 subsection 3 talks about other entities where you can claim depreciation on WDV method. In 33 subsection 2, we said it's a power generating units. 33 subsection 3 talks about other units other than the power generating units where you can claim depreciation on WDV method on applying the block of assets by following the block of assets concept. 33 subsection 4 talks about a situation where if the asset is put to use in a particular tax year for less than 180 days, then you have to claim 50% of the depreciation rate that has been allowed in that particular section. So suppose if the asset is put to use for more than 180 days, whatever the rate specified in the schedules, you have to claim. If it is put to use for less than 180 days, you have to claim 50% of that particular rate. 33 subsection 5 talks about a business reorganization. Say there may be amalgamation, demerger, or succession of businesses. In those cases, for that particular tax year, when this business reorganization happens, the depreciation amount can be claimed between the two entities on proportionate basis. To give an example, say suppose there is an amalgamation of a company in a particular tax year. So after 7th month, the amalgamation happens. So first 7 months it is amalgamating company. The next 5 months it will be amalgamated company. So whatever the depreciation you calculate for that tax year, so first 7 months it will be claimed in the hands of amalgamating company. The next 5 months it will be claimed in the hands of amalgamated company. Like that, there may be demerger or succession of business like proprietor firm or partnership firm succeeded by a company or conversion of company into LLP. In all those cases, it says proportionate basis, the tax depreciation has to be claimed. 33 subsection 6 talks about in case of assessee who has not owned the asset, but it is a leasehold assets. Even in case of leasehold assets, if he has incurred certain expenditure, capital expenditure, and built certain buildings or something like that, that also he will be eligible to claim the depreciation under section 33 subsection 6. It's what it says. Then 33 subsection 7 talks about a situation where it says whether or not the assessee has claimed the depreciation in a particular tax year, it is assumed and presumed that depreciation has been claimed. So there may be a situation where assessee is not interested to claim the depreciation, but whether or not he claims the depreciation, 33 subsection 7 says, irrespective of assessee claims the depreciation or not, it is assumed that the depreciation has been claimed. So future, if you want to have certain calculations, say suppose if you are selling that particular property or some other things, wherever you have to arrive at the book value of that particular asset, irrespective of whether you have claimed the depreciation or not, it is assumed that depreciation has been claimed. So you have to compute the particular value of the asset after claiming the depreciation. 33 subsection 8 talks about additional depreciation. So in case of certain industries where they are into the manufacturing of articles or things, if they purchase a new plant and machinery in a particular year, they will be eligible to claim additional depreciation. 33 subsection 9 talks about rate of additional depreciation. So it says the rate of additional depreciation is 20%. So in case of the asset put to use for more than 180 days, it is 20%. If the asset is put to use in a tax year for less than 180 days, it will be 10%. And next year, they can claim the remaining 10%. Then 33 subsection 10 talks about a situation where we saw like 33 subsection 2 top, if you see the depreciation for power units under SLM. If they have claimed the depreciation under this, if the power generating units have claimed depreciation under this straight line method, and subsequently if they are transferring the assets, so any amount that has been received by transfer of the asset or discarding or demolition of that particular asset, that will be claimed as a deduction in a section that should be written back under section 33 subsection 10. Then 33 subsection 11 talks about unabsorbed depreciation. So unabsorbed depreciation means like the situation where the depreciation, the amount of profit before claiming deduction under section 33 is, we have to compare that with the amount of depreciation. If the profit amount is less than the depreciable amount that has to be claimed, so to that extent only we can claim the depreciation. Or if there is no profit, it is loss, then what the section says is the entire depreciation has to be carried forward as unabsorbed depreciation, and the subsequent year it should be claimed as a current year depreciation. So whenever you carry forward this unabsorbed depreciation to the next year, that will be considered as a current year depreciation. If you read this particular section, this was there, the provisions, the same thing was there in earlier 32 subsection 2. The same wordings are there, the same thing is there. But if you start reading Income Tax Act 2025, and if you read this, you may get a doubt whether if there is a depreciation loss in a particular year, I have to compulsorily carry forward to the next year and claim under the profits made under income from business or profession, or whether in the current year when I got a depreciation loss, whether I can claim under any other heads of income. The answer is yes, you can claim under any other heads of income except the income from salary. So it doesn't mean that the current year business loss cannot be set off against other income. So when we talk about business loss, including the depreciation, unabsorbed depreciation, you can claim under any other head of income, any other income except income from salary. And 33 subsection 12, the last subsection, it defines certain terms for section 33. So it defines certain terms for depreciation. It may define the type of asset sold, know-how, and WDV. So this is what I should say, the composition of section 33, subsection 1 to subsection 12. Now, the last section under this deductions is general conditions for allowable deductions. So this was earlier section 37. So what are the general conditions? One of the general conditions for allowing deductions under section 34 is it should be wholly and exclusively used for the purpose of business or profession. So that is the first condition, should be wholly and exclusively used for the purpose of business or profession. And further, section 34 says it should not be a capital expenditure. It should not be a personal expenditure of personal nature, because under section 34, capital expenditure will not be allowed. That will only be allowed under the respective sections. And also it further it says, section 34 says, any deduction allowed under section 28 to 33. If you see the previous slide, where I had given the list 28 to 33, plus going forward 44 to 49 and 51 and 52, where deductions are allowed under those specific sections, that again will not be allowed under section 34. So this is what section 34 says. Then it also says, if the expenditure incurred is an offense under any law, or it is prohibited under any law, that will not be allowed as a deduction. Then it says that if a company is incurring any expenditure towards CSR activities, that is corporate social responsibility activities, that also will not be allowed as a deduction. And finally, it says for amount incurred for advertisement in any souvenir or brochure or pamphlet published by a political party. All these expenses which has been incurred by an associate, which is an offense or prohibited by law, or for CSR activities or advertisement by a political party, all these things also will not be allowed as a deduction under section 34. Now other sections are there where it allows as a deduction, section 44 to 52. I have only covered few sections, rest of the things I have not covered in this discussion. That for section 44 is amortization of certain preliminary expenses. So whenever you incur preliminary expenses, either a company or other SSC, that will be claimed as a amortization. So in the year of incurring that particular expenditure, 1/5 will be claimed, and subsequent 4 years, 1/5 you will claim as a deduction. Then section 45, erstwhile section 35, talks about expenditure on scientific research. So there are various types of expenses which is allowed under section 35 as a scientific research expenses. Here also there is certain situations where even capital expenditure is allowed as a scientific research expenditure. This is one more section where capital expenditure incurred for scientific research is also allowed as a deduction. Then section 46, capital expenditure of specified business. Earlier also I said 35 AD and 46, where an assessee claims the expenditure, capital expenditure as a deduction, he is allowed to claim under section 46. Either he can claim as a capital expenditure or he can show it as a fixed asset and claim depreciation. But he has got an option to claim as capital expenditure under section 46 with respect to specified business. Section 47, 48, 49, 51, I am not discussing. I will go to section 52. So this is 1/5 of total expenditure. So these are the sections under which expenditure on scientific research will be allowed as a deduction. If you see 45 1A here, capital or revenue expenditure incurred on scientific research related to the business of research. So even capital expenditure is allowed under this section. Then capital expenditure of specified business, as it is option, shall be allowed a deduction of the whole of the capital expenditure incurred. So this specified business is also they have defined around 13 to 14 types of businesses. They have identified as specified business. So if thus is incurring capital expenditure, he is allowed to claim that particular expenditure. Next comes section 52, amortization of expenditure for telecommunication services, amalgamation, demerger, scheme of voluntary retirement, etc. So this is also a section which deals with amortization of expenditure. The first one is amalgamation or demerger expenses. So wherever in a particular year there is amalgamation or demerger, so the entire expenditure will not be allowed in that particular year. So if a company is incurring expenditure towards amalgamation or demerger, entire expenses will not be allowed in that particular year where they incur that particular expenditure, but it will be amortized over a period of 5 tax years. So in the year you incur that particular expenditure, 1/5 will be claimed, and subsequent 4 years, 1/5 will be claimed as a deduction. Then voluntary retirement payments. See, off late we are not seeing so many VRS schemes. Earlier, maybe if I remember, around 10 to 12 years back, a lot of companies, especially the PSUs and the nationalized banks, announced these voluntary retirement schemes. So if an employer is incurring towards this voluntary retirement payments as per the approved scheme, it is not that entire amount what he incurs will be claimed as a deduction in that particular year, because if he incurs the entire expenditure, if it is allowed, it may, his balance sheet may become in red, like it may turn into loss-making company. So there is a proposition or there is a clause which says if you incur any amount towards voluntary retirement payments, that can be claimed over a period of 5 tax years, amortized over a period of 5 tax years. Then we have capital expenditure. This another section under section 52, where capital expenditure is allowed. It is for acquiring the right to use spectrum for telecommunication called as spectrum fee, or for acquiring a right to operate telecommunication service that is called as license fee. So we have something called spectrum fee and license fee, which companies will have to incur to acquire the right or to operate telecommunication services. So if whatever amount is being paid by a company to obtain the spectrum or license fee, it will be amortized. This is a capital expenditure. It will be amortized over the number of years during which that particular spectrum fee or license fee remains in force. To tell you an example, say a company buys the spectrum or license, say suppose by paying 10 crores for 20 years. The period of that license or spectrum is 20 years and they pay 10 crores. So over a period of 20 years, they will claim this 10 crores. So every year they will amortize 50 lakhs and balance will be carried forward. So 50 lakhs, 50 lakhs, 50 lakhs every year for 20 years, they will claim this 10 crores. So this is how they will claim the capital expenditure in respect of spectrum fee and license fee. Now in the example I said, a company has incurred 10 crores and it has taken this particular spectrum or license for 20 years. And it can amortize this expenditure for 20 years, over a period of 20 years. Now, there may be a situation where the company which is using this spectrum or license, it wants to sell this particular spectrum after 10 years. Let me take an example. Only with respect to spectrum, I'll speak. A company has taken a spectrum for 20 years by paying 10 crores and it can amortize this over a period of 20 years by claiming 50 lakhs every year. After 10 years, it wants to sell this particular spectrum. So for 10 years, it would have claimed 5 crores. The total amount is 10 crores for 20 years. For 10 years, it would have claimed 5 crores. So the amortized amount is 5 crores. The unamortized amount will be 5 crores. So in this case, amortized fee is 5 crores, unamortized fee is 5 crores. When once it transfers the spectrum after 10 years, say suppose the amount received for the transfer of the spectrum is 4 crores. So the sale proceeds is less than the unamortized cost. The difference 1 crore will be allowed as a business deduction. Say suppose instead of 4 crores, it is selling that for 6 crores, where the sale price exceeds the unamortized cost of 5 crores. The difference of 1 crore will be considered as income from business or profession. So this is the situation when they transfer the spectrum from one person to another person, that is one company to other company. But this may be situation where it is not transferring this to outside party, but there may be amalgamation or demerger of a company which is using the spectrum. In those cases, there won't be any adjustment in the books of accounts with respect to income from business or profession, neither expenditure nor income. But say if after 10 years there is amalgamation, so the amalgamating company would have claimed for 10 years, the amalgamated company will carry it forward for the next 10 years and it will claim as 50 lakhs every year. It applies to both the amalgamation, reconstitution or demergers of a company. That is what it will happen. And when once we talk about capital expenditure has been claimed, we will not, they will not be eligible to claim depreciation on this particular capital expenditure because they are claiming the entire capital expenditure over a period of useful life of the license or spectrum fee. In case of amalgamation or demerger expenses and voluntary retirement expenses, when you are claiming it as an amortization over a period of 5 years, that expenses cannot be allowed as a deduction under any other section under the act, that is Income Tax Act 2025. So this is with respect to section 52, where these are some of the sections specifically which will allow us as a business allowance. Now, after understanding the statutory sections which talks about business allowance, I have made an attempt to discuss this under various headings. So this is not part of the Income Tax Act 2025. I have just made an attempt where when you prepare a financial statement, you will come across all these type of expenses, that is direct material, labor expenses, administration, selling and distribution, or various expenses. Once you prepare what you call the financial statements, we come across all these things. So I made an attempt to identify the expenses under these heads and also understand how it will be allowed as a deduction. So first one, we'll take it as direct material. The direct material cost, what we understand is the total expense of raw material and components directly traceable to a finished product, forming an integral part of it. So whenever you take a finished product, whatever the material which will form part of this particular thing can be considered as a direct material. When I talk about direct material, direct labor and direct expenses, usually it will be in the case of manufacturing entity, or like direct material may be in other things also, trading also, but usually we associate this with the manufacturing entity. How I have discussed this particular heads of income. So I've just noted down like this: the nature of expenditure, the section under which it will be allowed as a reduction, then the TDS and TCS rate that is applicable, and the GST rate and the input availability, and some of the conditions. So if there are certain conditions for claiming TDS or for claiming GST input, I have just mentioned that. So let us try to analyze each and every expenditure under this particular head, under these subheads. First one is purchase of raw material, will be allowed as a reduction under section 34, and the TDS or TCS for this depends on case to case basis. Section 393(1), serial number 82. So before getting into this 393(1), let me tell you, I think by this time all of you must be aware, we had various sections for TDS under Income Tax Act 1961. Maybe almost some 40 sections were there, but now it has been brought down to 2 sections. We have only 2 sections for TDS. One is section 392 and section 393. 392 deals with salary payments and any other payments towards what you call this employee related trusts and provident funds like that. So whenever there is a fund which has been created for the welfare of employees, any contribution made to them which is subject to TDS, which is covered under section 392. All the remaining payments which were there earlier have been clubbed under one section, that is section 393. So from 193 to 194A, all those things, 194T, everything was there in earlier section. Everything has been brought under section 393. We have only one section for all the other payments, one for salary and other related, 393 for all the other payments. In 393, we have got three subsections: 393.1, 393.2, and 393.3. 393.1 talks about payments to residents, and 393.2 talks about payments to non-residents, and 393.3 payments related to any person. So any person can include both residents and non-resident. When we talk about 393.1, 393.2, and 393.3, there are tables given in all the three sections, which covers various types of payments. In that, they are mentioning the serial numbers. So serial number 1, 2, 3, 4, 5, 6, 7, 8, depending upon the number of items that has been covered, we have the serial numbers. So now if you take in this case, I'm saying that depends on case to case basis, 393.1, serial number 8 to 0.1%. In the 1961 Act, it was under section 194Q. So depending on case to case basis means we have to see the threshold limits. Whatever the threshold limits was there earlier, the same threshold limits are there in the current act also. So if the purchase is more than 50 lakhs and if his turnover in the previous year is more than 10 crores, then under section 194Q earlier, now it is 393.1, serial number 8, subsection 2 or subclause 2, 0.1% has to be deducted. Then depending on the type of goods purchased, whatever the GST you pay, you will get the input credit. Same thing applies to purchase of consumables and spares. Now, first one I spoke about raw material. Then similarly, consumables and spares also, the same thing applies here. TDS is at 0.1% and the GST will get the input credit. Now, purchase of finished or trading goods. The earlier two we are talking about manufacturing industry. Now, maybe if I can take as a trading trading organization, finished or trading goods, if you purchase, again, depending upon the case to case basis, the TDS rate may be 0.1%, and whatever the GST you pay, you will get the input credit. Then cess, duties, and taxes paid on purchases. There are many duties or cesses that you may pay. This is not the GST I'm saying. Apart from GST, there will be so many other cess and duties, and there's no TDS on that, and no GST. There's no GST, but the condition is ITC shouldn't be claimed. So ITC should not be claimed on all these things. So if nothing has been claimed, then it can be allowed as a deduction. Then there is something called depletion or evaporation of oil and shortage or deterioration of material. If you few people are doing any audit of say petrol bunk or accounting of petrol bunk, this thing, so you'll know that these certain materials like petrol, especially petrol and diesel, even if it is not used, there is something called evaporation of oil. So in those cases, the depletion or evaporation of oil, whatever as per the industry standards it is there, it will be allowed as a deduction under section 34. Then we have shortage or deterioration of material. Some of the materials, there may be deterioration due to the nature of the materials. Say suppose if I want to tell you like fruits or vegetables, after a certain period it will deteriorate. So shortage or deterioration of material also will be allowed as a reduction as per the industry standard. If when I say as per the industry standard, there may be normal shortage or deterioration of material. There may be abnormal deterioration of material. So the normal loss is allowed as a reduction as per the industry standard. Abnormal loss also will be allowed as a reduction, but one more condition is that whatever the GST input, if you have taken on the particular purchase of those material, in case of abnormal loss, we have to reverse the GST. Materials used for approval. So industry, especially this pharmaceutical industries, whenever they finish bring a final product, before releasing that to the market, it has to be sent for certain testing purpose for approvals. So those things, whenever it is issued for approval, that is also allowed as a reduction. There is no TDS and no GST for that. And this is a situation of purchase of land as stock in trade in real estate business. So the land is not purchased as a capital asset, but it is purchased as a business asset, as a stock in trade in case of real estate business. So in those cases, what is the TDS or TCS rate? Say if the resident, if he is a resident seller, it will be at the rate of 1%. The section is 393.1, serial number 31. Earlier it was 194 IA. And for non-resident sellers, which was under 195, it is 13%. So here I am considering it as a long-term capital asset. So whenever purchase of the asset, I have taken it as 1%. And in case of non-resident sellers, it will be 13%. 13% comes as 12.5% plus 4% cess, which comes to 13%. And here one thing we have to note, if the sale consideration is less up to 50 lakhs, it can be 13%. If it is between 15 lakhs to 1 crore, then the rate of TDS may be 14.3% because you have to add 10% surcharge. Beyond 1 crore, you may have to add 15% surcharge, which can come to 14.95%. This being a capital asset and it's a capital gain, the surcharge maximum is 15%. You need not calculate or compute 25% and 37% surcharge. So the TDS rate may be either 13% or 14.3% or 14.95% in case of land purchase. There's no GST on that. Consideration paid not in kind under JDA. So this is another situation where you are not purchasing a land as stock in trade, but you are into real estate business, but you are entering into a joint development agreement and you are paying certain consideration. So here the TDS will be at the rate of 10%, 3931 serial number 32. There's no GST on that. But the condition is joint development agreement to be executed and that it has to be a registered document. Now coming to the next aspect, that is direct labor. Direct labor involves the employees who are directly involved in manufacturing goods and services. So who are all actually engaged in the manufacturing activity in the factory shop, that expenses what you pay to them is considered as a direct labor. So the nature of expenditure is wages paid to workers in factory and overtime charges paid to workers. So when once we say workers in the factory, they are on the rolls of the particular employer. So whatever the amount you pay under section 392 TDS will be done. This is as earlier 192, now it is 392 as per the slab rates. Even the overtime charges paid to workers or any commission or bonus, whatever you pay, it's all considered as salary and the TDS will be under section 392. There is no GST. Instead of having your own employees, some of the employers can outsource certain works. So subcontract labor charges. It's not that all the process you will do within your entity or your unit. Some of the processes you can outsource it, like you are sending it for labor charges. In those cases, under 194C earlier, now it is 3931 serial number 61. The TDS can be either at 1% or 2%. And whatever the GST they charge, I have just written 18%. It may be 18% or 12% or 5%, whatever it is. 12% I think is not there. So 5% or 18%, whatever the GST it has been charged, you will claim the input credit. Now we'll move on to the direct expenses, which is directly traceable to the production activities, which will be used in the factory shop. One is the factory rent. The section is 28(1)(c), where it will be allowed as a reduction. And if the owner is resident, the TDS will be at the rate of 10%. And if the owner is non-resident, the TDS rate may be 31.2%. So whenever you are making payment towards factory rent, you should ensure whether the owner is a resident or non-resident. Otherwise, the TDS rate, there's a huge difference in the TDS rates. That has to be ascertained. And if they charge GST, the input is available. Next comes the electricity charges. So electricity charges is allowed as deduction under section 34. Now when it comes to section TDS, I have written 393(1) serial number 82 at 0.1%, similar to that 194Q. Why does electricity charges should we deduct TDS is the question. The answer is electricity charges is considered as goods. So whenever any of your assessee is paying electricity charges which is exceeding 50 lakhs, then he is supposed to deduct TDS under this particular section, earlier under 194Q of 0.1%. Now coming to the GST, whether GST is aware at the input is available on electricity charges. Before discussing whether input is available on electricity charges, now we should understand whether GST is chargeable on electricity charges. In certain situations, GST is chargeable on electricity charges. Say suppose it's a composite rent. A person is taking a particular premises on rent and the owner is charging a composite rent. One is for the use of the premises. The second one is for the electricity charges, which he supplies. So in those cases where it is a composite rent, he will give an invoice both for rent and electricity and charges GST. In those cases, GST if you are paying, you can claim it as an input credit. Or there may be a second situation where an assessee is getting electricity generated through generators. So he's giving a contract to a particular electricity generating unit to generate electricity through generators and supply the electricity. In those cases also, GST will be charged by that particular supplier as service, and that GST can be used as an input credit. The third situation may be where a person is generating electricity through wind power or solar this thing, and is supplying this particular thing to the grid, who is a licensed distributor. From the grid, a private distributor purchases this particular electricity and he will supply it to the assessee. So whenever the electricity is taken from private distributors, they may charge GST. In those cases, whenever there is a GST charge on electricity charges, that if it is used for the purpose of business or profession, you can claim the input credit. Next comes the water charges, claimed as deduction under section 34. And if you are taking it on contract basis, there will be a TDS under 194 CR12, now either 1% or 2%. Now the question is whether GST is applicable on this, and if they charge GST, whether input is available. So if they charge GST, input is available, but there is a condition. If you see the last column, condition is there, where it says water should be used in the manufacturing process. So only and only if the water is used in the manufacturing process, then you will get the input credit. So what is this water used in manufacturing process? It can be used as a ingredient of the manufacturing for the finished product. Say suppose somebody is manufacturing some jam or fruit juices or other juices, where water is also an ingredient of that particular finished product. So that can be used in the manufacturing process. Or usually water will be used for cleaning purposes or so many other things. Water is quite essential. If it is used in the manufacturing unit or the factory which manufactures all these items, then that will be considered as you can claim input on the GST that has been charged. Then royalty paid on production volume. Some of the places, maybe in case of literature, you can see if you are selling certain products or generating a particular product or selling a particular product, on the production volumes, you are supposed to pay royalty to the person who has given that particular intellectual property. In those cases, there's a TDS at the rate of 10%, and if they charge GST, that also will get the input credit. Then depreciation on factory, land and building and plant and machinery. We have understood section 33 discusses with the depreciation. So depreciation that has been provided on these things, there is no TDS, no GST. The conditions are there. Assets must be wholly or partly owned by SSC and must be used for business or profession. There is one more condition for claiming depreciation. When it comes to depreciation head, I will discuss that. Repairs and maintenance to factory building also allowed as a deduction. TDS and input is available. Carriage inwards. In this case, carriage inwards, usually the GST will be an RCM. So if you pay a GST and RCM, wherever it is applicable, input is available. So wherever I have to discuss certain things, I will take it. Otherwise, I will move fast with all this expenditure. Insurance to factory premises and assets allowed as a deduction under section 28 1A, no TDS, input is available. Primary packing material. So in certain industries, there will be two types of packing materials. One is primary packing and the other one is secondary packing. So primary packing materials I have shown under direct expenses. The secondary packing materials will be shown as selling and distribution expenses. Here also, if the purchase is more than 50 lakhs, the TDS will be at 0.1%. And whatever the GST they charge, you will get the input credit. Cost for special drawings and designs. So this is a situation where in case of manufacturing unit, they may order for specific drawings and designs to manufacture a particular article or thing. This being a technical service, we have charged TDS at the rate of 10%, 3931 serial number 63. And after getting the special designs and drawings, you have to convert this into molds or structures, which can be on a contract basis. The TDS is 1 or 2%. Then software services being professional service at 10%. Equipment hired for special job. So this may be a situation where the assessee may not have all the equipments. He may take certain equipments on hire. So here, instead of 10%, we have charged at 2% because 194I erstwhile, if you have seen, the same thing continues here also. 3931 serial number 2 subsection subclause 2, where the payment is made towards renting a equipment or plant and machinery, instead of 10%, it will be at the rate of 2%. GST will get the input credit. Then comes the administrative expenses, which is an indirect expenses, not a direct expenses with respect to the manufacturing or production. Rent to premises is allowed as reduction 28(1)(c), depending upon the case to case basis, it is 2% or 10%. Some of the sections, if you see 393(1), it talks about specified person and other than specified person. Who is the specified person? So it has been defined under section 402. Specified person means all persons apart from individuals and HUF. They are all considered as specified persons. And in case of individual and HUF, they'll be considered as specified persons if they are doing business and in the previous year their turnover or total gross receipts is more than 1 crore, and if they are doing profession, their gross receipts is more than 50 lakhs. So these people are considered as specified persons. Apart from this, other persons are considered as other than specified persons, especially basically they are individuals and HUF where they are doing business and their turnover in the previous year is less than 1 crore, and if they are doing profession, their gross receipts is less than 50 lakhs, they are considered as other than specified persons. If it is other than specified persons, if they are paying rent to premises, they are to deduct TDS at the rate of 2%. Electricity charges similar to what we discussed earlier, the same thing applies. When it comes to water charges, same thing applies, but here we have to see is input is not available because water charges, the condition is it should be used for the manufacturing process, which is not there for electricity charges. So water charges, that condition is not there. Condition is there. So if it is used for manufacturing process only, you will get the input credit. Otherwise, you will not get the input credit because it is for administrative purpose. Telephone internet charges, keyman insurance, no TDS. General repairs and maintenance, whatever the assessee incurs, whether it is for business, for building, plant and machinery, furniture and fixture, computer, everything, it will be allowed as a reduction. And the TDS at 1% or 2%. Printing and stationery, if you are purchasing printing and stationery from a particular shop, there is no TDS. There is no TDS. But if you have made to order, so if you are ordering certain printing and stationery materials from a particular person, it's considered as a contract basis, and TDS will be there either 1% or 2%. Postage and courier charges, local conveyance, no TDS and no GST. Accounting charges. See, if you are not employing an accountant in your own firm, the assessee is not having his own accounting staff, but he is outsourcing this accounting work to an outsider, then the TDS will be at the rate of 10%. And if they charge GST, you will get the input credit. Then the traveling expenses, no TDS, but if the traveling is abroad, like when you are making payment outside India, there may be certain TCS. Payment outside India, there's a separate heading. There I will discuss. Otherwise, local traveling, there is no TDS. Computer maintenance charges, then security charges. Security charges, usually we deduct TDS at the rate of 1% or 2%. And sometimes security, they charge GST, sometimes it may be on RCM. Whatever it is, you will get the input credit. Now here, let me have to discuss something. Security charges is something like supply of manpower. So earlier we had a confusion with respect to supply of manpower. If not with security charges, other supply of manpower, say suppose it is a professionals or technical supply of manpower, where it has to be deducted, whether under 194C or 194J, where it is 2% or 10%. So some of the golden rule is there in TDS. Maybe all of you may be aware of that. Otherwise, I would just for the benefit of the audience, I will tell. There's 3 golden rule under TDS. One is under TDS, you are not supposed to do any tax planning. Second golden rule is if you have a doubt whether to deduct or not to deduct, you have to deduct. The third golden rule is if you have a doubt, if you have confusion whether it has to be deducted at a lower rate or higher rate, the golden rule is always deduct at the higher rate. So with respect to this supply of manpower, especially with respect to the technical supply of manpower, they had a confusion whether it has to be deducted under 194J or 194C. Now, in the new Finance Act 2026, there are certain amendments where they have included the supply of manpower. The 402 is a interpretation section for TDS provisions. 402.47 defines work. So under 402.47, subsection 47, they have defined or they have included under the definition of work, supply of manpower. So now when we talk about work, it is covering under one erstwhile 194C, now under 393(1), serial number 61. So all this confusion now has been laid to rest, where it is supply of manpower. It will be covered under 402.47, the definition work, where that also can be considered as a supply of manpower. Any supply of manpower can be considered as work under work, and the TDS will be either 1% or 2%. Insurance paid on land and building, plant and machine, furniture, fixtures allowed under 28(1)(a), no TDS, input is available. Vehicle insurance, no TDS. If they charge GST, input is available. Commercial vehicle used for further supply. The condition here is all the vehicle insurance you will not get a deduction. So it is not that every vehicle insurance you pay, you will get the deduction. There is a condition. It should be commercial vehicle used for further supply. So it should be a commercial vehicle which is used for further supply of the particular activity. In those cases only, the vehicle insurance paid will be allowed as a deduction. Sorry, you can claim the input credit. Otherwise, input credit you will not be eligible, but deduction will be allowed, and whatever, there is no TDS on this. So vehicle insurance which has been paid on a commercial vehicle which is used for further supply only, if GST they charge, you will get the input credit. Shailendra sir? Shailendra sir?
Yes, sir. Yes, sir.
So the speed is okay? There are any questions or something like that?
No, sir. As on time, there are no questions. So we will cover the questions at the end of the session only, I guess. You are doing wonderfully well, sir. Very elaborate. You started with the interpretation section, then one by one business allowances, then thereafter how the TDS have been linked with the sections. Then the depreciation, you also explained very well, sir. The speed is good, sir, I guess.
No problem, no? Okay. Pankaj
Yes, sir.
has come. Pankaj has come.
No, I am not seeing, sir, Pankaj, sir.
Okay. So now we move on to other expenses, maintenance of guest house. So if you are maintaining this guest house on a contract basis, the TDS will be there. On whether input is available. If the guest house is used for business promotion purpose, input will be available. If it is used for the personal use of the employees or the owners, you may not get the input credit. Software purchase and maintenance, of course, as a professional fee, TDS will be there. And if it is on contract, it will be 2% or 10%. Website development and maintenance charges. Today, every industry will have their own website for the development and maintenance. They have to incur expenditures. Losses due to frauds and cash embezzlement, it will be allowed as a reduction if there is any loss. No TDS and no GST. Theft of stock in trade and consumables. This also will be allowed as a reduction. But here, one thing we have to understand is ITC, which we have claimed earlier on the stock in trade and consumables, it has to be ITC reversal on stolen stocks or assets, that is consumables, has to be done. So if there is a stock in trade where you have claimed the input credit on the purchases, subsequently there's a theft of stock in trade, ITC reversal has to be done. Now coming to the employee related expenses. These are all costs a business entity incurs to employ staff, covering salaries, benefits, taxes and overheads. It also includes certain costs incurred to maintain and support its workforce. So what are those expenses? One is the main thing is salaries to employees, where the TDS is under section 392 as per the slab rate. Then these are some of the expenses which is incurred towards employee related welfare expenses, which will be considered as perquisites in the hands of employees. One of the expenses is rent for accommodation provided to employees as perquisite. So whenever the expenses are incurred for providing certain benefits to the employees as perquisites or other things, any GST that you pay on that, input will not be available. That is one standard rule that we have to understand. If it is used for the employee's personal usage, then input will not be available. Even though GST is charged, you cannot claim the input. And the rent paid, if the owner is a resident, the TDS will be at 2% or 10%. If the owner is non-resident, section 393 subsection 2, it will be 31.2%. So whenever you come across a client where he is taking a particular property on rent and it is being given to his employees as rent-free accommodation or rent-free furnished accommodation or without furnished accommodation, first thing you have to ascertain whether the owner is a resident or non-resident. Accordingly, the TDS rate will change. Then rent for movable assets provided to employees as perquisites, same thing. Whatever the TDS rate you have to see and that has to be applied. Input is not available. Apart from this, there are so many other type of expenses where the employer will be incurring for the welfare of the employees. One is education to employees and family members, or training of employees, or provision of utilities like gas, water and electricity, or provision of sweeper, maid or helper. If they are taking it on professional basis, the TDS will be at 10%, or on contract basis, 1% or 2%. In all these cases, wherever the GST is charged, you will not get the input credit because it is used for the purpose, private personal purpose of the employees. So you will not get the GST input credit. Then provision of food to employees, staff welfare expenses. If you are taking this on a contract basis, so you are employing some contract to supply food to the employees, the TDS will be there. Whether you will get input credit, that is GST credit, is a question. So here there is a condition where if canteen facility is mandated by law. So every government or a state government, I can say, like there may be a mandatory requirement for a particular size of a company that canteen facility is mandatory. Say suppose if I can take an example, say suppose a particular state says if you are employing more than 50 workers, then there are certain facilities which has to be provided. One of such facility is canteen facility. So if it is mandated by law and if the employer has to get this particular canteen facility, any GST that has been charged on that thing, whatever he gets from outside, he can claim the input credit. Otherwise, he cannot claim the GST input credit. Provision of transport to employees. So the employer may provide certain transport facilities, which will be allowed as a reduction under Section 34 for commuting this particular employees from house to office or office to residence. So for all those things, if he is taking that particular vehicle on contract basis, TDS will be there. Whether GST input will be available. So the condition here is if the vehicle capacity is above 13-seater. If vehicle is above 13-seater capacity. So the vehicle capacity should be more than 13. Then only he will be eligible to claim the GST input credit. In fact, this particular topic I have been discussing from past 2 months over almost 18 to 19 branches I have visited physically. This is the first time I am doing a virtual webinar, but otherwise almost 20 places I have discussed this. In one of the branch when I was mentioning, they were saying, sir, in our place in auto, 15 people will be traveling. So whether any GST that has been charged on that, whether we can claim the input credit. So it is not on a particular vehicle, how many people are traveling. It is based on the capacity of the vehicle. So auto capacity may be 8 or 10 and means a bigger auto I am saying. 15 people may be traveling, you will not get the input credit. So the condition is the vehicle capacity should be more than 13. So it's not the number of people who travel in that particular vehicle. It's the capacity should be 13-seater and above. So there may be a 13-seater, 15-seater, 21-seater vehicle where even 10 people may be traveling, but you will be eligible for GST. But if there is a 10-seater capacity and 15 people are traveling, you may not be eligible for GST input credit. Contribution to ESA and PF employees, no TDS, no GST. It will be allowed under Section 29(1)(e). Group medical insurance also we discussed earlier, Section 30C. It will be allowed as a deduction. So here, when once you take group medical insurance, if GST is charged, you will not be eligible to claim the input credit because it is for the personal use of the employees. Then ESOP grant expenses. All of us are aware that a lot of companies will announce these ESOP schemes to the employees. So whenever these ESOP schemes are given, that equity shares are given, it will be charged to tax in the hands of the employee in the year when he exercises that particular options as perquisites. Now we are talking about the employer. So whenever he is giving this ESOP schemes or ESOP this thing, how we will claim the expenditure. So this ESOP grant expense is what we call, that is fair market value minus exercise price. So the employer will award the ESOPs, and for a period of say 4, there will be something called a vesting period, which will be for 3 years or 4 years. So year 1, the employer will announce the ESOP scheme, and he will see what is the fair market value on that particular date minus exercise price. He will calculate, and the number of shares that will be considered as ESOP grant expenses. This the employer can claim over a period of vesting. Say suppose in the employer announces ESOP and the vesting period is for 4 years. So whatever the calculations he does, like ESOP grant expenses, that will be claimed over a period of 4 years. That is a vesting period. 1/4, 1/4, 1/4, he will be claiming as a deduction. Then staff welfare expenses here, input is not available because it is a general staff welfare expenses. There we saw that it was a canteen facility which has been required. Here the general staff welfare expenses, which is for the personal use of the employees, input is not available. Bonus and commission paid to employees. Then promotion of family planning among employees, which we already discussed. Both the revenue expenditure and capital expenditure will be allowed as a deduction. Then comes the finance charges, which the employer will incur. It may be interest paid on term loans of business or interest paid on CC or OD. There may be bank charges paid or processing fee paid. In case of interest and on term loans and CC or OD, there is no GST. And the TDS may depend upon the case-to-case basis. When I say case-to-case basis, if paid to scheduled banks, TDS is not applicable in all these cases. But if it is paid to NBFCs, whether it is interest paid or bank charges paid or processing fee paid, you may have to deduct the TDS. And if they charge GST, input is available. Otherwise, there is no input available. Next, some of the rates and taxes, like motor vehicle taxes for commercial vehicles. If the employer is having certain vehicles which is used for commercial purposes, any taxes that he pays will be claimed as a deduction. GST paid on which ITC not claimed. So we were discussing where input is available or not available. So there are certain expenses where GST is paid on which ITC is not claimed. Those cases, entire GST paid can be allowed as a deduction, can be claimed as a deduction. License fee paid to set up business. Some of the businesses you may have to pay certain license fee, that is also allowed as a deduction. Security transaction tax we discussed earlier under section 32 subsection K, it is allowed as a deduction, provided the income that you earn from that transactions is charged to tax as income from business. If it is income shown as income from capital gains, security transaction tax paid will not be allowed as a deduction. Property tax on business premises, land revenue, that also will be allowed as a reduction. Coming to selling and distribution expenses, first one is advertising and marketing expenses. If you have taken a contract, it will be 1% or 2%, or if it is taken on professional services, it will be at 10%. Here also I have to mention one thing. 194C work. If you talk about contract, earlier 194C, the contract included the first word as advertising. Now, in the Finance Act 2025, they have made an amendment with respect to the professional services. I think 402, 32 or some 32 or 38, I don't remember the exact subsection. Professional services, if you see, there also they have included the word called advertising. So now this advertising word is there both under work, which is under 194C earlier, and also professional, which is 194C earlier. So now the confusion is whether this advertising should be treated as a work or a professional services. So there's no confusion here, or we need not get confused with this. So wherever we use this professionals, the TDS will be at the rate of 10%. Otherwise, it will be on contract basis, where the TDS will be at the rate of 1% or 2%. Where it is professional means, if you see any advertisement today, whether it's in, if you watch a TV, any advertisement which comes, they will use the professionals. The professionals means they use the artists, the actors, and also sports persons. So both actors, artists, and sports person are considered as specified professional under section 62 subsection 4. So all those people are considered as professionals. So whenever you make payment to these professionals, you will be deducting TDS at the rate of 10%. Otherwise, wherever you're using the contract, this thing, it will be 1% or 2%. Then comes this holding charges. All of us would have seen major holdings where if you are making any payment to the holding charges, it will be considered as rent and the TDS will be at the rate of 10% under 194I, and whatever the GST they charge, it will be allowed as a deduction. Commission and brokerage paid, it is paid to outsiders. The TDS is at the rate of 2%. Business promotion expenses, then perquisite or benefit paid to dealers. So we discussed earlier under section 26 what is charged to tax in the case of dealers. So whatever the income earned in the case of the perquisite or benefit received in the hands of dealers will be considered as income from business. But what the employer pays will be allowed as a deduction under section 34, and TDS will be at the rate of 10%. Earlier it was 194R, now 393(1) serial number 8, subclause 4 at the rate of 10%. Then warehousing expenses, the TDS rate will be at the rate of 10% because it is also under section 194I. Now there is something called cold storage expenses. The difference between warehousing expenses and cold storage expenses is, for warehousing expenses we have deducted TDS at the rate of 10%, but for cold storage expenses it is at 2%. This is considered as an equipment or plant and machinery. Performance incentives paid to sales staff because they are staff of the employer. 392 section will be applicable as per slab rates. Carriage or transport outwards. Cash discounts allowed is also allowed as a deduction. Packing material expenses. In direct expenses, we spoke about primary packing material. Now it is secondary packing material. The TDS rate is at 0.1%. Whatever the GST they charge, input is available. Payments made to online operators. 194O was there earlier. Now it is 393(1), serial number 85, 0.1%. Free samples. Payment to artists and sports person residents, it is at 10%. If payment made to non-resident sports person or non-resident sports association or artist, 393 subsection 2, serial number 1, a TDS rate is at 20%. This is the depreciation methods, that is WDV method, is straight line method and additional depreciation. The conditions also I said, there is one more condition. If the payment is more than 10,000 in a day to a person, otherwise than by specified banking or online mode, will not be considered as cost of acquisition. So when I say specified banking or online mode, I explained earlier, if it is a check which is not an account pay check, it will not be considered as specified banking transaction. Or if it is paid through cash, again it will not be considered as specified banking or online mode. So if any payment is made exceeding 10,000 in a day to a person, otherwise than by specified banking or online mode, that should not be considered as a cost of acquisition. That should be deducted from the cost of acquisition. On the balance only you have to claim the depreciation. Then interest on capital and remuneration, of course, this is a new section 194T, where the TDS is at the rate of 10%. Directors remuneration. So directors remuneration, there may be two types of directors. One is executive director and non-executive director. If he is an executive director, TDS will be at the rate of under section 392 because he is considered as an employee of the particular company. If he is a non-executive director, it will be at the rate of 10%. And in case of non-executive director, if you make the payment, you have to pay the GST and RCM basis and you will be eligible for the input credit. Then director sitting fees, same thing, the TDS rate is at 10%. GST and RCM you have to pay and you can claim the input credit. Then this is professional, technical and consultancy charges. So when you make payment to various professionals, who have been specified professionals defined under section 62 subsection 4, the TDS rate is at the rate of 10%. And if they charge GST, you are eligible for input credit. So payment to chartered accountants, company secretaries and CMAs, then engineers, valuers, architects and actuaries, artists and sports person, they are also considered as what you call this professionals. And payment to corporate trainers. So all these cases, similar thing, that is 10%. And if they charge GST, you will get the input credit. In fact, while preparing this presentation, I told my people to add payment to corporate trainers and Gurujis and Swamijis also. Because usually if you see, we call this Gurujis and Swamijis to give lectures to our employees, and they also charge huge amount. Like corporate trainers, they also charge the amount. So I thought I will add this Gurujis and Swamijis in the list of corporate trainers. When the final print came, I thought whether I should use this Gurujis and Swamijis, or I should remove that. Then after analyzing, I thought I should remove that, because whenever you make payment to Swamijis or Gurujis, they will not take in their own name. They will take on behalf of the ashrams or something charitable trust which they run. So it's for the benefit of the charitable activities. They come and give the lectures, and they will take in the form of donations. As such, donation is not an allowable expenditure. I am talking about business allowance. So then I decided, let us not have that. So whenever you make payment to certain trusts, where you call some of the Swamijis and they give lectures, if you are making in the form of cash or banking transactions or in kind also, that will be considered as donation, which will not be allowed as a business deduction. Apart from this, there is one more professional called lawyers. Whenever you make payment to lawyers, TDS is at the rate of 10%. But in case of GST, they are not supposed to register under GST. So when we take the services of lawyers and we make the payment, so GST should be on RCM. You have to pay the RCM and you can take the input credit. Lastly, you put the payment to land surveyors. So land surveyors is also considered as professionals, but they're considered as technical people. So instead of 10%, we have claimed the TDS we have deducted the TDS at the rate of 2%. So for land surveyors, which is considered as a technical service, we have deducted TDS at the rate of 10%, and you can claim the input credit. Payments outside India, payment towards royalty and fees for technical services. Earlier it was under section 115A, now it is section 207. As per that, you have to deduct the TDS. Then payment towards medical treatment of employees or education of employees or their family members. There is no TDS, but TCS is there. For TCS also, there is one section now, that is section 394. And under TCS, we have got only three rates, either 1%, 2%, or 20%. So most of it is 2%. Only one case that is 20%, and there's one more case that is 1%. Otherwise, TCS, most of it is 2%. So payment through LRS other than medical or education, the TCS rate will be 20%. And payment towards overseas tour program package, TCS will be 2%. So there may be a situation where you are giving a foreign tour package to the dealers. So there, the TCS may be done at 2%. You may have to do TDS also at 10%. So there may be a dual thing where when you make payment to a overseas tour operator, he may collect TCS at 2%. You may have to deduct that particular expenses at 10% TDS. So that there may be a conflict in these type of situations. Then payment towards business income. So business income, usually we have to see whether the person, when you are making payment to a non-resident as business income, the nature of business income, you have to see whether he has got a permanent establishment in India. If he doesn't have a permanent establishment in India, then it is not subject to TDS. Those things you have to see before deducting TDS. Payment to foreign professionals and consultancies, same. If the foreign professionals doesn't have a fixed place in India, there also the TDS may not be applicable. If it is applicable, it should be as per the rates in force. Dividend paid as per section 207, interest paid to non-resident by any person, TDS as per rates in force. Amount paid for imports, there is no TDS. Services received from abroad, TDS as per rates in force. I'm just rushing through because already we are on 750. So this brings us to the end of business allowances under the various statutory provisions, and also the different heads of under different heads, around 16, 15, 14 heads I have discussed. These are the expenditure for business allowances. Now we will move on to the next vertical, that is business disallowance. Of course, we have only 3 sections here, so it will not take much time. We will complete this business disallowance quickly. Section 35, 36, and 37, which talks about amounts not deductible in certain circumstances, or expenses or payments not deductible in certain circumstances. And finally, certain deductions allowed on actual payment basis only. So let us see what is this. The erstwhile sections were 40, 40A, and 43B. So amounts not deductible in certain circumstances, section 35. So it says 35A says any amount of tax paid on income, that is income tax paid or tax paid by employer or tax paid in any other country for which relief is eligible will not be claimed as a deduction. Then 35B 1, 2, 3, which talks about expenditure where it is subject to TDS. TDS deductible, not deducted, or TDS deducted but not paid, not remitted. So all these situations, if the payment is made to resident, 335B1 says 30% of sum payable to a resident will be disallowed. In case of payment made to non-resident, 100% of the amount will be disallowed. Any interest, royalty, fees for technical services or any other sum paid outside India, 100% of the amount will be disallowed. And any payment to a provident or other fund established for the benefit of employees, if no TDS has been done, 100% of that particular amount will be disallowed. Then comes 35C, where payments is chargeable under the head salaries payable outside India, that is to a non-resident, and TDS has not been done, 100% of that amount will be disallowed. Then 35D is one section, one clause which says if any of these amounts paid by a state government undertaking to the state government, that will not be allowed as a deduction. Next comes one of the important section, that is 35E. Earlier it was 40B and 40B4 and 40B5. So this is expenditure paid by a firm to a partner. Firm includes partnership firm and LLP, where it is making payment towards partners as interest on capital, and in case of working partners as remuneration. So interest on capital can be paid, can be allowed as a deduction to all the partners. When it comes to remuneration, it has to be paid to the working partner only, not the non-working partner. And both the interest and the working remuneration should be in accordance with the partnership deed. So it has to be authorized by the partnership deed. So, and earlier 40B4 spoke about allowing interest on capital. 40B5 spoke about remuneration. Now in this particular section, it has been reversed. 35E3 talks about remuneration. 35E4 talks about interest on capital. And whatever the rates, earlier also it was 12%, now also it is 12%. And the slabs also same, 6 lakhs and balance, 90% of book profit and 60% of book profit remains the same. So the definition of book profit, working partner, everything is same. Now the question here is, now 35F is any expenditure incurred by association of persons or body of individuals towards the members, it will not be allowed as a deduction. Under 35E, the question here is, now it says it should be in accordance with the partnership deed. Now we have an existing partnership deeds which is drafted under section under the Income Tax Act 1961, and we have mentioned 40B4 and 40B5. Now for the previous year it is okay. For the current year, the current tax year 26-27, whether having the same partnership deed, we can claim interest on capital and remuneration. This is a question. The answer to this is we have section 536 which talks about repeal and savings. So whatever is there, was there in 1961 Act, some of the things can continue in Income Tax Act 2025. And as such, there is no change in the Act or in the concept between 1961 and 2025. Many provisions, many privileges which was there under section Income Tax Act 1961 will continue in the Income Tax Act 2025 also. Relying on that, so whatever the partnership deed is there with you for the previous year can continue in this year and you can claim the remuneration. Having said that, whether you have to take some precautions. The question is whether we have to change the partnership deed across India, whether it is a LLP deed or a partnership deed was a question. Then we discussed and said that there may not be any need to change this partnership deed across India. For all the partnership deeds or all the LLP agreements, we need not change. The thing is, in case of partnership forms, maybe you can prepare one codicil, one small stamp paper you can buy, 2 rupees or 20 rupees stamp paper, and the codicil can be prepared. And you can mention these clauses, the earlier clauses and the subsequent, now the new clauses under the Income Tax Act 1961 and the Income Tax Act 2025. You can mention the change in the clauses and you can get it signed by all the partners and keep it. Or the other thing is, if you can talk to some of the businesses where they are doing some serious business, it's not a family partnership firm, where you have outsiders also like 4 or 5 people who are not from the same family or forming part of a partnership firm, you can call them and have a discussion with them. This is the changes that has happened. So if they agree, you can buy the stamp paper based on your state where you are there. You can change the partnership deed. So it's not that compulsory you have to change. You can talk to respective firm. You can inform them this is what has happened. If they feel that let us draft a new partnership deed, you can buy the immediately. You can buy the whatever in your state the requisite stamp paper. If you want, you can buy it. Now also you can buy, because today if you buy also 6 months validity will be there from with effective from 1st of April 2026. You can make the amendment. Or the last thing is, whenever you get a next opportunity, please mention the new Income Tax Act 2025 and the new clause 35E for claiming the interest on capital and remuneration. Then section 36, expenses of payments not deductible in certain circumstances. Earlier it was 40A2. A payment made to specified person, that is relatives. So if it is, if the assessing officer feels it is excessive or unreasonable, then he may disallow that particular expenses. This need not be only to relatives, specified persons. As I said earlier, any payment, if he feels it is unreasonable or expensive, there is chances that he may disallow. 36.4, 36.5 and 36.6. This is payment made exceeding 10,000 to a person in a day, other than through specified banking or online mode. So in 1961 Act, you would have seen the word cash. Now in 2025 Act, they mention specified banking or online mode. So if any payment, this is 40A3 earlier, this is 40A3A. So any expenditure incurred in a tax year, if you are making more than 10,000 to a person in a day, other than through specified banking or online mode, that is basically the cash payment or not account payee check. So in those cases, it will be disallowed. And if this is that 43A, this is 36 subsection 5, where you have incurred an expenditure in a particular tax year and you have created a liability, not paid the amount, but in the subsequent year you are making that payment, you are clearing the liability, not the expenditure. In those cases also, you cannot make a payment more than 10,000. And there is an exception here. Instead of 10,000, it is substituted with 35,000, where you are making a payment for plying, hiring or leasing of goods carriages. In those cases, instead of 10,000, it can be 35,000. And rule 26 is there. Earlier 6DD was there. So the exceptions are given for all these above sections. In those, if you are falling under those exception situations, even if you make payment beyond 10,000 or 35,000, it will be allowed as a deduction. Then section 37, the last deduction section under business disallowance, it says deduction allowed on actual payment basis only. So such payments, any provision to the contrary in this act or method of accounting regularly followed, or the tax year in which the liability was incurred, irrespective of this, any of these expenses, here there are 7 types of expenses, it has to be paid before filing the return of income under section 263 subsection 1. Then only it will be allowed as a deduction. Which are those payments? One is taxes, duty, surcharge or fee levied under any law in force, contribution to employer to a provident fund or superannuation fund or gratuity fund, or even any other welfare fund like ESA or PF, amount payable in lieu of leave encashment, bonus or commission paid, or any loans or advances or borrowings from specified financial entities, or amount payable to Indian Railways for use of railway assets. A to F is the 6th type of payments which the employer, if on a SSC, if he has to claim it as an expenditure, it has to be paid before the due date for filing the return of income, that is 263 subsection 1, which will be 31st of October every year. If he is paying before that date, it will be allowed as a deduction. If he pays beyond that date, it will not be allowed as a deduction. The last, that is G, amount payable by SSC to a micro or small enterprise beyond the time limit specified in MSME Act 2006. So in case of micro and small enterprises, which is covered under this MSME Act, the payment has to be made if there is an agreement beyond 45 days, maximum is 45 days. If there is no agreement for payment, it will be 15 days. So in those cases, it has to be paid within that particular thing. When it comes to A to F, the due date for filing the return of income is 31st of October in case of audit cases. But as chartered accountants, we have to give the audit report by 30th of September. So what the situation is, by 30th of September, we have to certify whether the amount has been paid or not. If it is not been paid, we have to disallow under Form 3CD. But the assessee has got time up to 31st of October to make this payment. The assessee will say, I will make the payment before 31st of October. You allow in the 30th of September. So that should not be done. So if the amount has not been paid on 30th of September, we have to disallow in Form 3CD and file the return. And if he makes the payment, say suppose he is making the payment on 25th of October, then maybe you can revise this Form 3CD, and then the assessee can claim that as an deduction in his computation, and he can file the ITR. So whenever you file the first original 3CD and then the revised 3CD, you don't forget to generate UDIN, two separate UDINs for both the things. Now coming to the other specific provisions, there are so many sections. I thought of discussing section 38 and 53, but now already we have reached 8 o'clock. Now straight away we'll go to section 58, which is the third vertical, that is presumptive taxation. Shailendra sir,
Yes, sir. Yes, sir.
so now it is 8 o'clock. How much more time I can continue?
So the session is going wonderful, but we don't know how the audience is
Okay.
feeling, because there is no window to know the things.
No,
But
anyway.
I'm thoroughly enjoying, elaboration on the subject is very good, sir, going on.
Okay. No,
And
no,
as you said, section 58 we will complete and then take a pause for question and answers.
okay, sir. Any questions have been there or
Not yet, sir, because I
Okay.
guess the question and answer will be.
Okay, okay. So we'll move on to section 58, which is a presumptive section. Earlier we had three different sections, 44AD, 44AE and 44ADA. Now everything has been combined under one section, 58(1), which is talks about presumptive taxation in case of residents. There is 58 subsection 2, which has got a table. 3 tables are there: serial number 1, serial number 2, and serial number 3. Serial number 1 talks about computing a presumptive taxation in case of business. Special provision for computing profits and gains of business. Erstwhile 44AD, now it is serial number 1 for 58 subsection 2. So we have to see which is the specified business, the eligible assessee, and the presumptive basis on which you have to compute the taxation. The specified business is any business other than business in table serial number 2. And we have to see the turnover or gross receipts. Then once we see the turnover or gross receipts, again one more criteria is to be there. We should verify what is the quantum of cash receipts, whether it is less than or equal to 5% of the total turnover or gross receipt. If it is yes, you can go up to 3 crores. If it is no, up to 2 crores. So if we have to see the turnover of the particular business from the specified business, and if the cash receipts is less than 5%, the limit can go up to 3 crores. Otherwise, it will be stopping at 2 crores. Who are the eligible assessees? The eligible assessees basically are the residents. So this particular clause will not be applicable for non-residents. Who are the eligible assessees? The individual, HUF and partnership firm. Here you can see LLP is not eligible. So specifically they have eliminated LLP. And the persons who are not claimed deduction under section 144, not claimed deduction under chapter 8C, not a specified profession. This is defined under serial number 3. Not earned commission or brokerage, not carrying on agency business. All these things were same, but in this Finance Act 2026, this was removed. Not claimed deduction under section 144. Earlier, it was not claiming deduction under section 10A or 10B. This is basically this units under special economic zone. So units under special economic zone were not eligible to enter to this presumptive basis taxation, but now they have removed this particular this thing. So now even the units under special economic zone can opt for this presumptive basis. Then what is the computation of income? Aggregate receipts by specified banking or online mode, 6% of the total turnover or gross receipts received in the tax year or up to 263(1). So in these cases, it is not under tax audit. So the due date may be August 31st. So we have to see up to August 31st, not up to 31st of March. You should go up to 31st of August. Whatever is received in this specified banking or online mode, 6% of the turnover can be charged, or plus other modes, 8% of the turnover or gross receipts received in the tax year, or actual profit earned, whichever is higher. So the practical problem here is we can calculate these percentages, but actual profit earned is a big question mark. How to arrive at the actual profit earned? So it says either this percentage or actual profit earned, whichever is higher. Because in all these cases where they're declaring the income, deemed income under this respective percentages, there's no question of maintaining books of accounts. So it will be difficult for any person to ascertain the actual profit earned, but the law says either of this or actual profit earned, whichever is higher, should be offered for taxation. Then for 58 subsection 2, serial number 2 talks about special provision in case of business of plying, hiring or and leasing goods carriages. Earlier it was section 44 AE. So here the eligible assessee is an assessee who owns less than 10 goods carriages anytime during the year. So owning also includes the deemed ownership. The presumptive basis here is we have to see the aggregate of income from goods carriage. So here there is a classification of the vehicles, heavy goods vehicle and other than heavy goods vehicle. Heavy goods vehicle means having a capacity of more than 12,000 kgs, and any vehicle which is considered a heavy goods vehicle, we have to take ₹1,000 per ton of gross vehicle weight or unladen weight. Say suppose you have got a vehicle which has got a capacity of 15,000 kgs. So 1,000 rupees per ton means 15,000 rupees per month or part of a month. So for each vehicle for every month or part of a month owned during the previous year, plus other than HGV vehicle, it is 7,500 per month for every vehicle. So here the one condition is at any time during the tax year, you should not own more than 10 goods vehicle. So you'll be eligible to claim under this section 58 subsection 2 serial number 2 if he owns less than or equal to 10 goods carriage at any time during the tax year. Here also it says actual profit earned, whichever is higher. The next one is section 58 subsection 2 serial number 3, special provision for computing profits and gains of profession. Serial number 1 was with respect to business. Serial number 3 is with respect to the profession. Specified profession, specified assessee and presumptive basis. So specified professional has been defined under section 62 subsection 4. Here also we have to see the gross receipts. And again, one more test is the criteria is to apply whether it is less than 5% or more than 5%. If the cash receipts is less than 5%, you can go up to 75 lakhs. If it is no, up to 50 lakhs. So the limits is 75 lakhs or 50 lakhs. The specified assessee means the resident being individual or partnership firm. Here also LLP will not be eligible to claim this particular section. What is the computation? Aggregate receipts, banking mode or online mode plus other modes. So here we don't have a separate section, separate rates. Like earlier we had 6% and 8%. Here we don't have 40% or 50%. It's only one rate. So 50% of gross receipts or actual profit earned, whichever is higher. So in all these cases, actual profit earned, to determine the actual profit earned is a Herculean task, which is not very easy for us to determine the actual profit earned in case of serial number 1 and serial number 2. But in case of serial number 3, where it is a professional, what is happening now is in the ITR form, if you want to file under the presumptive basis, they're asking what is your total investment as on 31st of March, total bank balance as on 31st of March. So when once you start declaring all these things, the system will compare what was your investment as on 31st of March previous year and what is your investment as on 31st of March this year. So if it compares that, if there is a difference, say suppose there's a situation where your investments you have shown as 50 lakhs in the last year, this year you are showing your investments as 1 crore. There's an addition of 50 crore, 50 lakhs, but you would have offered only 30 lakhs as income. Then there may be a situation where it can detect because now everything is computerized, that they are using this technology to the maximum extent. So the server itself will say you have declared your investments of more than 50 lakhs addition, but you have only declared 30 lakhs income. So what happens to this 20 lakhs? So that whether that can, you may receive a notice as unexplained income. So other means what I should say, other things, provisions will apply. Say now I'll give an example for this professionals. Say suppose a person is receiving 5 lakhs per month as professional charges, and for 1 year he will receive 60 lakhs. And being a specified profession, he is eligible to claim this particular thing under 44 ADA or 58 subsection 2, because assume all the everything is coming under banking mode, specified banking. So through banking channels you will get, so you can go up to 75 lakhs, not 50 lakhs. So this case, what are the example I gave, 5 lakhs per month he is receiving, total 60 lakhs he receives, he will be eligible to claim presumptive taxation under this clause. Now, say suppose you will come and say, let us declare 50%. We will declare 50% means out of 60 lakhs, we will declare the income of 30 lakhs. So 30 lakhs is what we declare as income, and we pay the tax, whatever the tax, which are based on this either individual or partnership form, whatever the tax we will calculate and we will pay the tax. But when once you take his bank account, you may have 50 lakhs or his investments may be 50 lakhs. We have offered or given, shown the income of only 30 lakhs. What happens to this 20 lakhs? The difference of 20 lakhs, if assessing officer feels that this is an unexplained income, then it can be charged at the higher rate. In under 1961 Act, it was considered as unexplained income. Under section 115 BBE, the rate of tax was 60%. So 60% plus 25% surcharge plus cess, everything put together, it used to come as 78%. Plus there was a penalty under section 270A, which was 10%. Whether it could have charged or maybe it would have been not charged also. Assuming it has been charged, the total tax rate will be 88%. 10% additional tax on 60% plus whatever surcharges. He was ending up paying tax at the rate of 88%. Now in Income Tax Act 2025, there is an amendment that 60% has been reduced to 30%. So now the tax rate is 30% under the Income Tax Act 2025. The surcharge and cess remains same, that is 25% and 4%. So it comes to 39%. But what has happened in Income Tax Act 2025 is, earlier it was only a penalty of 10%. Now this type of situations have been covered under section 195, 195(1) and 195 1A and 1B, where it is considered as misreporting of income, underreporting of income and misreporting of income. It has been brought under this particular clause. So 195 1B is underreporting of misreporting of income. It is considered as misreporting, underreporting of income. So when assessing officer ascertains that this is the amount which has not been declared, then it is considered as underreporting of income. Then the penalty will be 200%. So in the example what I gave, so if the 30% is a tax rate, the 200% will be the the penalty, which comes to 99%. 39% plus 60% comes to 99%. In the example what I gave, 20 lakhs is the amount which is extra investment which has not been offered to tax. The assessing officer feels that this is the unexplained income or unexplained investments on that 20 lakhs. If they charge 99%, they may have to end up paying 19,80,000. So what my suggestion to all of you over the listeners here, any client comes and says, let us declare at 50% or 60%, whatever the rate. Before that, let us explain these provisions to them, say that actual profit earned has to be offered to tax. And we will also explain all these things and take a declaration from them. This is the actual profit, and then file the return of income. Just like that, let us not stick on to this presumptive rates is what I wanted to mention here. Now 58.3, okay, declared PGBP less than deemed PGBP and total income exceeding basic exemption limit, then they have to maintain books of accounts and get it audited. Now in case of serial number 1, that is in case of business person who is opting this particular this thing, the declared PGBP is more than deemed PGBP in tax year 1, he can continue to claim this particular section for next 5 years. Say suppose there is any deviation. Say year 2 there is a deviation where he has declared PGBP income less than deemed PGBP. Then section 58(7) says it contravenes section 58 subsection 1. Then he will not be eligible to opt for this particular thing for the next 5 years. Succeeding 5 tax years cannot opt 58 subsection 2. And 58.8 says his income in the next 5 years is more than basic exemption limit, then he has to maintain books of accounts and other documents and get accounts audited and furnish report under section 63. So for the next 5 years, he has to maintain books of accounts and get it audited. So here, one thing I have to say, 58.4 is newly introduced in this Income Tax Act 2025, where it says loss, allowance or deduction allowable under the provisions of this act is not eligible for all these three: serial number 1, serial number 2, and serial number 3. What it means is, say suppose an assessee is claiming presumptive on presumptive basis offering for is calculating his income, but he has got some unabsorbed losses from the previous year. Earlier we could have claimed that particular unabsorbed losses. Now it says no allowances will be allowed under these particular provisions. It also says no deduction. Suppose eligible assessee is eligible to claim deduction under chapter 6 or now chapter 8, whatever that some of the deductions that is allowable. If he wants to claim also, now it says he is not eligible to claim those deductions. This is one new amendment under the income from business or profession. 58 subclause 4 has been introduced, where no losses, allowance or deduction under the provisions of this act will be allowed for all these presumptive basis income. Now let's discuss whether above presumptive provisions are optional or mandatory. The answer is not optional. It is optional. It is not mandatory. It's optional. So assessee can decide whether he has to go under this particular scheme or not in the initial years. Say in case of serial number 2 and serial number 3, he can decide on yearly basis. Say in case of a profession, he can opt whether to go under this particular thing or not to go under this particular thing. But when it comes to serial number 1, that is in the business, we would have seen earlier, when once he opts into that particular thing, he should stay for the next 5 years. Otherwise, he has to maintain books of accounts and get it audited. Now, the last segment under income from business or profession is maintenance of books of accounts and tax audit. Of course, there's no change in the provisions compared to 1961 Act or 2025 Act. Just quickly, let us understand what is it. So, maintenance of books of accounts. In case of professions, they talk about only specified profession. Who has to maintain the books of accounts? It says Rule 46 deals with maintenance of books of accounts, where the specified professional earns gross receipts of more than 1.5 lakhs, he has to maintain books of accounts. In case of other profession or business, and if it is done by individual or HUF, if it is an existing business in any 3 previous tax years, or if it is a new in the tax year, we have to see whether his total income is more than 25 lakhs or gross turnover more than 25 lakhs. So either 25, if he has got a turnover of more than 25 lakhs or income of more than 2.5 lakhs, he has to maintain books of accounts. Other than individuals or HUF, the total income should be more than 1.2 lakhs or gross turnover more than 10 lakhs. They have to maintain the books of accounts. Now, what are the books of accounts to be maintained? So, Rule 46 talks about maintenance of books of account. What to maintain, where to maintain, how to maintain, and period to maintain if you have to discuss. So, we have to maintain a cash book, a journal and ledger, and you have to maintain the copies of bills or original bills and receipts wherever the payment is exceeding 250. And in case of medical profession, they should also maintain a daily case register in Form 25. Where to maintain? The place where he carries on the profession. Basically, this 46 talks about profession, specific profession, but we can incorporate this for both profession and business. Where they carry on the business or profession, they have to maintain the books of accounts there. And if they have more than one place of business or profession, and if they are maintaining separate books of accounts for each and every place, the books of accounts should be maintained in those places. How to maintain? Either electronically or manually. Now there is one amendment, this in section 46. If they are maintaining electronically, backup has to be taken on daily basis if the server is located in India. So wherever the server is located in India, they are maintaining an electronic mode, backup has to be taken on daily basis. And this we have to certify if it is under tax audit under Form 26, the new Form 26, which is replacing 3CA, 3CB and 3CD. One clause is there where you have to mention whether backup is taken or not. So all your clients who are maintaining books of accounts under electronic mode, you ensure that they are taking backup on daily basis. Period to maintain the tax year and then subsequent 7 tax years. So totally 8 years you have to maintain the books of accounts. Because under Income Tax Act, you may not get the notices beyond 8 years. So it's okay. Up to 8 years, legally you can maintain the books of accounts. But there are so many other laws. Like there may be other laws, like it may be FEMA or from ED or some other cases, you may get the notices beyond 8 years also. That is our luck or bad luck, I should say. If something comes beyond 8 years and if you don't have the documentation, then you may be under problem. Otherwise, usually statutorily, you have to maintain the books of accounts for 8 years. Then comes the tax audit, section 63, earlier 44AB. The limits are same. In case of business, the total sales turnover processes exceeding 1 crore. This is under serial number 1A. Serial number 1B says instead of 1 crore, it can be 10 crores. So it can be substituted with 10 crores. But the this condition is we have to verify the aggregate cash receipts and aggregate cash payments. It should be less than 5% of the total receipts and total payments. When we talk about cash payments and cash receipts, whether it is only revenue payments or it includes even capital receipts and capital payments, it includes both revenue and capital receipts and capital payments. But only thing which we can ignore is the contra entries, that is cash deposited into bank or cash withdrawn from bank. Those things can be avoided, can be removed. Otherwise, all the cash payments, including revenue cash payments and capital cash payments, revenue cash receipts and capital cash receipts, everything should be considered. Then 63(1) table serial number 1C with respect to the profession, where the gross receipts in profession is more than 50 lakhs, it should be subject to tax audit. And 63(1) table serial number 2, which is the situation where the declared PGBP is less than deemed PGBP. Under section 58, we saw, and 61(2) is a situation where in case of non-residents, the presumptive basis. So wherever you have declared less than the deemed PGBP, and if you have opted and you have declared less than PGBP, then you have to maintain the books of accounts and has to get it audited. And this is under serial number 2. So whenever you do the audit under serial number 2, it will not be counted for the tax audit limit of 60. It will be outside the purview of 60. 63(4) says where some of the assessees, they are supposed to get their accounts audited under any other law, not under the Income Tax Act, then that will be a sufficient this thing. If they get their accounts audited under the specified act, specified law, and file the report within the specified due date. Specified due date means 1 month prior to the date of filing the return of income, that is 30th of September. So these are some of the miscellaneous provisions which I'll not be dealing. This computation of actual cost, section 39 and WDV and all. So this, because of want of time, I'll not be dealing. I will be sharing this PDF file of the presentation, which has got all these provisions. Maybe if you can go through that, you can definitely understand. Or again, this is an opportunity. One thing I have to tell to all of you, we should thank the Finance Minister for introducing the new Income Tax Act 2025, so that it's an opportunity for all of us to revisit or venture into the Income Tax Act 2025 and go through with all the provisions of Income Tax Act 2025. Because we don't know when we have studied the entire Income Tax Act 1961. Maybe I have studied 30 years back when I was doing my CA final. So I used to read the BEAR Act. Now I should thank really for the introduction of the new act. So at least I can keep studying some of the provisions. I don't think I'll study all the 536 sections immediately. But now because of this presentation and all, I've been studying all these sections. I request all of you who have participated in this to start studying. If you have not purchased the Income Tax Act 2025, I can show this Income Tax Act 2025 and the rules. Both are been released by DTC. We are also publishing this from the DTC. We are publishing both Income Tax Act and Income Tax Rules 2026, which is at a very is a reasonable price. Income Tax Act 2025 is sold at 500 rupees and Income Tax Act rules at 700 rupees. If you get into your CDS portal, you can order for these books and you can have this book and start reading this. Finally, once again, I should thank the DTC and the chairman and vice chairman for giving me this opportunity. I also thank all the participants who have been patiently listening And this is very difficult as a webinar. I can't see anybody's face except my face. So I don't know how is the mood or the reactions of the participants. If it is a physical thing, definitely I can understand. Once again, I thank all of you for giving me a patient listening. Thank you.
Sir, yes, yes, sir. Thank you, sir. I'm very much assured and trustworthy that the audience would be very much delighted by
Thank-
listening you. So before concluding this webinar, there are a couple of questions that I wish to take. With
Yeah,
your permission, sir.
please, sir.
Okay, there is one question by Sanjay Patwari ji that saying that section 26(4) says that income from letting out residential house shall be chargeable only under income from house property. Does
Yes.
this mean letting out of commercial property can be taxed under income from business?
So basically, this amendment happened in the last year. This is only continued in the current year also. Whenever there is if you're a person who is owning that particular property, so if it is the owner is letting out that property, it has to be charged to tax another head income from house property only, not another head income from business or profession. So to negate some of the decisions, they have made this amendment. So if you are the owner of the property, it has to be compulsorily charged under the head income from house property.
Okay, sir. Now coming to the second question is regarding if my business turnover is 50 lakhs, that is below 1 crore, in which case I am mandatorily required to offer income under 4480, that is erstwhile 1961 sections. I can file regular returns without any audit requirement under 44AB, declaring actual profit or maybe a loss. Please clarify.
Sir, last line I said, now let's discuss whether it is optional or mandatory. So 44 ED is not mandatory, it's optional. So if a person with the 50 lakhs turnover doing business, he need not go for 44 AD. Earlier 44 AD, now section 58. So if he is not opting for 44 AD, he can maintain the books of, he has to maintain books of accounts. Whatever the percentage of profit, whether it is less than 80%, he can declare. Since it is less than 1 crore, there is no need for audit.
Thank you, sir. I'm very much sure that the questions asked, they might have seek the solutions, and the elaboration and deliberation on the subject is so detailed, because I also remember my CA final days when
Okay.
we start with the definition section. Likewise, you also started from the basics and go through every section of PGBP has been covered in a detailed manner. TDS also, then IGST, ITC, whether gate or not gate. Indirectly, sir, it's wonderful session, wonderful webinar. Definitely, there would be many more questions in the minds because this whole act is new. There would be more confusion, but we do organize. I request the DTC chairman to organize much more such sessions on the subjects. Thank you, sir, giving us this wonderful opportunity, being the faculty of the subject. Thank you, DTC, for organizing such seminar. Thank you, audience,
Thank
for
you so
patience.
much.
Thank you, thank you.
Thank you.
Is this on? Shall I leave it or what? Yes, sir. Thank you very much.
Thank you. Thank you also.